there's a war, nobody told earnings.
What's really driving the market higher has been extremely strong earnings.
If you look at the earnings we've gotten, they've been incredible.
The earnings story is overpowering.
As far as kind of the main driver here, it will continue to be AI.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, entering May at all-time highs. The S&P 500 looking to build on the biggest monthly advance since 2020 as Apple is wrapping up mega-cap tech earnings topping forecasts. Investors are shaking off elevated oil prices as the president maintains the naval blockade.
I love this. People said that this market would not be able to keep rallying if you saw this blockade continue, or if you saw the Strait of Hormuz continue to be shut. Not only have we rallied, as you just said, we saw the biggest rally for a month going back to the height of the pandemic when we first were coming back. We were learning about vaccines in 2020. If you take a look at semis, we're talking about the best monthly rally going back to 2000. The why cannot be found in the bond market. The why cannot be found in the oil market. The why cannot be found in the currency market. It is squarely in the earnings, and it is a multifaceted bunch of earnings that have come in better than expected.
10% move on the S&P 500, 16% move on the Nasdaq 100. Phenomenal gains. The message from the market is pretty simple. Developments in tech are far more important to this market than developments in the Middle East.
Yeah, the fiscal stimulus of CapEx from the biggest tech companies is pretty tremendous. And it's not just those companies. It's also the ecosystem around them, whether it's Caterpillar, whether it's some of the other discretionary spending that is hinged off of some of the stock gains that we've seen that are tied to those tech companies. Just putting this out there, only 12% of companies reported have missed. That is the lowest share going back to 2021. That is so far in this earnings season. So it is broad-based, even amid this concern about the oil shale.
And the names you'd expect to do well haven't done well at all. Exxon, Chevron have done nothing for 2 months. Both of those companies report earnings later on this hour. Throughout this morning, look out for that. I want to start with this move in crude. Still elevated here, and the president committed to a naval blockade. In the president's own words, their economy is crashing. The blockade is incredible. Their economy is a disaster. We'll see how long they hold out.
And interesting to see that we're so far off some of the recent highs in crude. I mean, I just want to point out that we've reached 125 on Brent crude, and we've come back to 111, even as this blockade shows no sign of going anywhere. And frankly, people are still having the same conversation of who blinks first. What is the optimism baked into that? I know this is a strange thing to say, but what is the optimism baked into that we're going to reach a resolution sooner, especially as there are discussions and reports of potential strikes by the U.S. in Iran to expedite some of this coming to the table?
The president appears to have three options on the table right now: maintain the blockade, resume hostilities, or walk away. And based on the communication we've received from the administration throughout this week, he seems far more comfortable with option number one: maintain the blockade, keep the squeeze on, and see what happens next.
And frankly, a lot of analysts are saying it really is putting the squeeze economically on Iran. There are a number of stories about how the currency is completely tumbling, about how hyperinflation is really pressuring the political environment. That said, if you're dealing with an actor that doesn't necessarily have political goals in mind, how do you negotiate and use tools of leverage? How political are the decisions being made by the IRGC?
Equity futures on the S&P 500 just about positive to kick off the month of May. Where did April go? Said this a few times over the past few days. The first quarter felt like a lifetime. April, blink of an eye, gone.
Part of it is that in the beginning, we were talking about headline roulette, and we were talking about focusing on different things. And this, it was just a fire hose. I mean, it was just an absolute fire hose, and people felt pretty good because they were making money. So if you have a fire hose of information that you could digest and people feeling pretty good, well, time flies.
Coming up this hour, we'll catch up with one of those equity market bulls throughout all of this. Rajadhyaksha of Barclays, with stocks coming off the biggest monthly gain since 2020. We'll speak to Tom Forte of Maxim Group as Apple sees impressive sales growth, and Abigail Watt of UBS as the US economy shows some real signs of strength. We begin this hour with stocks looking to build on fresh record highs. Rajadhyaksha of Barclays writing, we were overweight risk assets last week on the belief that momentum would carry markets further, but we now turn more neutral. Ajay joins us now for more. Ajay, good morning. It's good to see you.
Good morning.
I want to give you some credit first, because the person who's not here today is Annmarie, and that's unfortunate because she gave you so much criticism last time for maintaining this bull case, despite the fact that we had the Strait of Hormuz closed. Can we start there? Why you were bullish, before we get to the turn to neutral, why you were bullish and why that worked out?
Right. So that was March 27th. I looked the data up, looked up how much stocks are up since then before I came back on. but better lucky than smart, John. So in this particular case, I think two or three things the markets were not factoring in then. The first is the economies that matter, the United States and China in particular, just had a much bigger buffer. China has 1.2 billion barrels in SPR. The United States is an energy superpower. The second thing, and we keep missing this crisis is not 8 weeks old, it is 5 weeks old. For the first 3 weeks, you still had tankers that had left Hormuz that were landing on shores, so people tend to forget that. And the third is that the starting point collectively for the world oil markets was looser than people realized. Last year, we had nearly 700 million barrels of inventory built up. Hormuz matters, but it's a much slower moving story than markets just got ahead of themselves, and then the power of earnings remind them that, let's not get carried away.
So we had a big cushion, bigger than people thought.
That's right.
We've worked through some of that. You've now turned neutral. Walk us through why you've developed a more slightly negative view on this market.
And the reason is because the pace at which inventories are now coming down, the first 3 week cushion is gone, right? The outage is about 10, 11, 12 million barrels a day. We are drawing down global inventories at 80 to 90 million barrels. It seems like a week. It seems like you said that the president is going to continue with this tactic. That means in another 2 to 4 weeks, if we continue here, no hostilities.
Sure.
But at the same time, no oil flowing through Hormuz, it is going to start to matter. That's what I'm trying.
This is slightly different, Bramo, to what we were talking about. The consensus right now in the street is it doesn't matter. The only thing that matters is tech, and that's what's got us here. What I'm hearing right now is that's about to change.
And frankly, that it has mattered. It just didn't matter in the same kind of way that people had expected. And you're starting to see that a little bit in some of the earnings coming through where people are saying, well, component parts are getting more expensive, and that's the reason why they have to raise more money. And that is going to pressure some of the capex that we keep hearing about.
How did the dominoes fall? You clearly think we're close to a tipping point. Where do you expect to see it show up first?
I think tipping point is still overstating it. I would not be outright short risk. Like I said, the weight of earnings is still too strong. But I do think that momentum's carried us in the last week, 2 weeks. No one wanted to be short earnings going into Wednesday for good reason. I mean, the earnings were blowout strong. People are not questioning AI capex the way they were 3 months ago. Its viability. I think we just trade around these ranges and probably stay like that until we have clarity on Iran. Then we take another leg upwards. It's not as clear-cut a message as a month ago, Jonathan, but here we are.
How much tension is built in the fact that we just saw the best monthly gain for the S&P 500 since 2020, and we reached cycle highs on benchmark yields around the world at a time where people are really worried about inflation and they're really worried about the central bank response to it?
There is a little bit of tension in equities, but I think it's more a bond story in itself, just an outright bond story. That is not a part of the duration market globally in the 10 to 15-year sector that I would touch with a barge pole, genuinely. Because the United States, the United Kingdom, Japan, France, it's not just the US. In every economy, fiscal profiles are worsening quickly. Inflation profiles, at least for 2026, will worsen. And there's no political will anywhere to do anything about it. We used to have this debt clock outside Times Square, remember?
Yeah.
We just ran out of numbers and we no longer... It's not like our debt profile improved.
So this is the reason why Fitch raised some concerns yesterday about the U.S. and its rating, especially given the fact that we have debt profiles right up there with, say, Senegal and Mozambique, but they are better than us. But I'm just wondering, from your perspective, at what point that challenges just how much further some of the equity valuations can run, just simply because we are going to be entering a new regime if other people also don't want to touch this with a 10-foot pole.
I think for the next month, Iran, and I know I come from a place where I downplayed Iran a month ago, but at this point, for the next month, what happens in Iran will matter more for the equity markets. But if you have a decisive breakout, if 10s in the US go to, say, 4.75 to 5%, that, I think, is the level at which the equity markets will pay attention, and not in a positive fashion. We still have some time. If you get a bond story here, it is much more likely to come out of Japan or France or the United Kingdom right now than the US.
Japan intervening in the FX market. What was your reaction to that yesterday?
I was not surprised. They have said that 160 is their line in the sand. But you speak about tensions. There's a fundamental tension here, which is that the Central Bank of Japan, by every metric except history, except the fact that they're coming out of 30 years of deflation, right, is much further behind the inflation curve than any other major central bank. And they still are incremental in their process. The Ministry of Finance can do as much as it can, but ultimately there's an economic underlying tension here, which is not going.
It begs the question, you're fighting a terms of trade shock right now. Why aren't you hiking interest rates if you're worried about the currency?
Not immediately. I don't think enough that you and I are here discussing why markets are down 10% because of a terms of trade shock. But it is a slow-moving thing, and it's not possible.
Well, they're about to do something in crude as well. Have you seen this headline from Japan overnight? Oh, this is crazy. We are always ready to act regarding crude oil futures transactions. That from a Japanese official overnight.
Well, they're used to, absolutely owning the market, so why not try it again? I do want to just finish up with not just the manipulation of markets, but why the dollar hasn't strengthened more. Because we keep seeing that the U.S. economy surprises to the upside. The central bank is getting a bit more hawkish on the margins than people had expected, even as you see a little bit more of a dovish read in some of the other places, whether it's Japan or Europe. Why is the dollar doing nothing?
So for dollar bulls, this crisis has been humbling. There's no question, right? This crisis was tailor-made for the dollar. We are a gigantic energy superpower. The two big markets that form the dollar basket, the renminbi and the euro, are not. They're giant energy importers. And as you said, the dollar struggled. And I think the reason is not because the world is shunning dollar assets at all, remotely. Not treasuries. Last year, US treasuries were the best performing long bond in the developed world. If you want AI exposure, you have to be in the US, or you can take your chances in China. So that's not it. It's just that people are increasingly increasing their dollar hedges. They're no longer willing to take a flyer on the dollar. That's the thing that has changed over the last year to 2 years from a 20-year journey. I think that's it.
So you don't really like the bond market. You're cautious on equities. What do you like right now?
All right. So I would still hide in Max 6 if you ask me.
Max 6. Which was the one that's not in the Max 7 anymore?
Oh.
Who gets chopped off?
I cannot believe you're putting me on the spot like this.
Well, you said Max 6.
I would put Tesla a little bit behind that.
Tesla's to one side.
Right.
Any particular reason for that?
I'm never going to be able to make it out of this room. I'm looking at forward valuations. I'm looking at free cash flows. I'm looking at all of the things that that are fundamental.
Okay.
And the other 6 just make a lot more money. That's literally the biggest reason. But I think, despite everything I've said, I think for now the European equity markets have gotten ahead of themselves. The US is not. The front end of the U.S. bond curve is still reasonable. I don't think the Bank of the Federal Reserve is going to hike no matter what. So
by the front end, you mean twos?
Twos, that's
okay.
Right. But there's slim pickings out there after a 14% rally, after the best April in a long time.
Pretty phenomenal stuff. And well called by you and the team, sir. Thanks for being here. We appreciate it. Thank you.
Thank you.
Rajadhyaksha there of Barclays following a 10% gain on the S&P 500 through the month of April.
Follow the earnings. He was the one saying it. And ultimately, the most important thing that he said that I thought really a lot of people haven't talked about, we have had a delayed crisis. It's really only been 5 weeks, not 8 weeks. So maybe the real pain starts about now.
You know when we have one of those conversations, you go home, you listen back to it?
Yep.
Just had one of those conversations.
I feel like that's every time with him.
Yeah. Fantastic work, as always. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahara Anand has more. Hey, Yahara.
Good morning, John. President Donald Trump says he's sticking with a naval blockade of Iranian ports. His comments coming after oil hit a wartime high. Iran's new supreme leader casting doubt on the likelihood of a deal, vowing not to give up the country's nuclear or missile technologies. The president says he'll remove some tariffs on whiskey following King Charles's visit. Trump saying he'll remove the restrictions so Scotland and Kentucky can start dealing again. Tariffs on Scotch have been a point of contention between the U.S. and the U.K. And the longest partial government shutdown ever is now over. President Trump signing a bill to fund most of the Department of Homeland Security except for immigration enforcement. Republicans plan to pass those funds separately in a budget bill that will not require Democratic votes. That's your Bloomberg Brief. John.
Yahara, thank you. A diplomatic breakthrough down in Washington, D.C. Well worth the trip by King Charles.
I mean, it's like, why, of all things that we're talking about the fire hose of news, whether it's one person invading in a bar, whatever, it's like Scotch.
Scotch, done.
Anyway.
OK, need a few of those. I think everyone does. Up next on the programme, Apple's strong quarter.
The quarter looks really good, above expectations in almost every metric. They're buying up all the memory they can to ensure that they don't run out, and that's going to put a lot of pressure on their competitors.
Up next, we'll catch up with Tom Forte of Maxim Group from New York City this morning. Good morning. got a big hour of energy earnings coming up. Exxon in about 15 minutes' time. Just heard from Chevron. Upside surprise. Adjusted EPS for the first quarter, 141. The estimate, 90 cents. That stock doing nicely in the pre-market. Exxon coming later. After that, ISM data, manufacturing for the month of April. Look out for that at 10 a.m. Eastern time. Just a read, another read on an economy that so far is doing pretty well. The equity market doing better than good. Stocks through April. We went through some of the numbers. The S&P up 10%, the Nasdaq up 16%. Bramo talked about chips. It's been a big story for us over the last month or so. The semi-index just had a 38% monthly gain in April, the biggest month since the year 2000.
And earnings still outperformed, and that's what people keep pointing to, the idea that demand is just insatiable and existential. Key point, though, a lot of different tech companies pointed to component costs going up. With the ISM manufacturing, with some of the earnings from the oil giants, how much does CapEx start increasing as everybody races for the same thing?
That's something to look forward to a little bit later. That conversation is going to pick up ahead of that data point at 10 a.m. Eastern time. Let's turn to crude. Brent and WTI still elevated here. Brent crude at 111, WTI around 105. We're higher by about 0.9% on Brent crude this morning. That's keeping yields elevated too. Your 10-year around 440 still, up a single basis point. Twos at 388, also up a single basis point. We asked Ajay of Barclays, what do you like right now? Don't seem to like bonds, don't seem to like the equity market as much. Front end of the yield curve. Don't believe the Fed's going to hike. Twos offer value here.
We hear that a lot. Ultimately, if you don't have conviction on anything else, have conviction in almost 4% coupon that you can clip for the next couple of years with the expectation that most likely it won't go all that much higher.
Let's talk about another central bank, the BOJ and the finance ministry in Japan. Why isn't the BOJ hiking? Why is it all about the finance ministry intervening? This move, this drop-off that you saw in yesterday's session from 160 down to about 156, it holds at 156.54. Nikkei the first to report that there was some real intervention here, not just the threat of it. We followed that up here at Bloomberg as well. It's the final advisory if you want to escape, and they didn't give people very long to get out, did they?
They gave them about 12 hours, then they spent $34.5 billion to intervene in this market. For what, I think? Number one, it gives us a sense that 160 truly is the line in the sand. And so people are saying, okay, I better get not that far away from that because you don't want to fight the Japanese authorities. What is their goal, though? And to your point, the Bank of Japan could have just hiked rates. Instead, they're forced intervening to try to prevent inflation from imported goods like fuel and other commodities. So a question here, what's their limit from basically putting up their money in flames?
You're fighting a terms of trade shock. Can you do that with one-off intervention in 24 hours? Maybe that keeps some people on the other side of the trade, just stepping back a little bit because they don't want to touch this right now. But ultimately, if you want a sustainable, prolonged move, you've got to do something with rates, no? Or something corrects with energy and you get bailed out on that side of things.
The interesting footnote, and I would love to hear more information, is that Japan was doing this in tandem with communications with the United States. So trying to understand exactly what could be behind all of this, I would like a roadmap. Maybe someone could come up with a Claude model.
Just want it all spelt out for you.
100%.
I don't blame you. Here in the United States, of course, a focus on other things, and it's technology, a massive week of tech earnings. Under surveillance this morning, Apple's strong quarter.
The quarter looks really good, above expectations in almost every metric. Every company that's not doing something with AI, so that's consumer, enterprise, electronics, are facing severe margin pressure because of the surge in memory prices. I think they're being strategically very smart what they're doing. They're buying up all the memory they can to ensure that they don't run out, and that's going to put a lot of pressure on their competitors.
So here's the latest this morning. Apple's rising after posting double-digit sales growth and delivering a better-than-expected revenue forecast. Tom Forte of Maxim Group with a buy rating and a $300 price target on the stock joins us now for more. Tom, welcome to the program. What did you like about what you saw yesterday afternoon?
Yeah, so Jonathan, I think there was a lot to like, although there was a lot of kind of everything in that Apple report, and the special guest, John Turnus, on the call was a bonus and a surprise. So what I really liked was that consolidated net sales exceeded expectations, despite the fact that iPhone sales slightly missed, and sales in China slightly missed. But I'm willing to give a pass on the iPhone and China when considering you've had 2 consecutive quarters of north of 20% revenue growth for the iPhone and nearly 30% revenue growth for 2 quarters ago in China. So I think that those are some good numbers, despite things I think you could point at with some small level of concern.
So, Tom, we'll get to that in a moment because I know Lisa's got questions about costs and what's happening with supply chains. Just on leadership, you mentioned Turnus. Is it new leadership, same approach, or do you expect some changes?
So, Jonathan, I thought it was interesting. The other thing they had in the quarter is that they're abandoning net cash neutral while at the same time announcing a new incremental $100 billion of buyback. So I know you've talked about Tim Cook as being the king of buybacks. So John Turnus will still have a lot of dry powder to buy back shares. So I think the story here is still quite good. And, I think that they'll still be returning a lot of money to shareholders despite the changing of the guard on September 1st.
Tom, there's some contradictory messages within these earnings. On one hand, they built up their R&D spending about 34% in the quarter. This is a departure since they've maintained a pretty subdued spending profile in this area, but they also are building cash. Do you think they're preparing to buy something, to pick up assets in a downturn? Do you think that they're trying to build something on their own? Are you getting any tea leaves?
So, Lisa, I absolutely think that Apple historically is almost always build versus buy. If they're buying, they're usually buying talent. So I think that it's clearly to build. John Turnus, again, as the next CEO, suggests they're still a hardware-first company, given that he was SVP of hardware engineering before being named apparent heir to Tim. So I would say that they're more interested in building. And then the other side of net cash neutral, abandoning that, is that they said they want to make sure that they have the ability to invest as much as they believe is necessary while still returning money to shareholders. So I think they're clearly investing.
Tom, about the component costs, as John was mentioning, this is something that keeps coming up on earnings calls from all the big tech players. They're going to increase their spend in part because everything is just getting more expensive. Is that still the same kind of spending, or does it become less beneficial in the eyes of investors?
Well, I think for Apple, there's a couple things that are working in its favor. When you have this strong of performance from the iPhone 17, I think they're able to generate better margins given the strong unit sales. When you look at that guidance for gross margin of 47.5 to 48.5, that's really good given the higher memory costs. And I think the other thing working in its favor now versus, say, 10 years ago is 18% give or take of their sales comes from higher margin services. So I think they are more buffeted when you have a material increase in component costs like we're seeing right now with memory.
Tom, just finally, the buybacks. Over the course of Tim Cook's tenure leading this company, what are we at now? $700, $800 billion in buybacks?
I still like to think of it as 350 billion market cap that turned into a 4 trillion market cap. Yes, buybacks played a role. Tim did an amazing job. So I think that the thing I'll be looking for in John's tenure is, like Tim, will he be able to sustain the life cycle of the iPhone? 5 years from now, will we still talk about the iPhone as 33 to 50% of revenue? And I think that's an important benchmark for John and something I'll be following closely.
I'm not playing down the achievements. Don't worry, Tom. They're phenomenal achievements. Tom, thank you.
They
Tom
are.
Forte
Poster
of Maxim
child
Group.
of the CEO after the founder, Jonathan.
Tom, very true. Appreciate it. Thank you very much. They've done great work. The stock is up again this morning by close to 3%.
Yeah, and they're running out of product, right? This cheaper than expected nano, micro, whatever computer that costs $500. They can't get them in stores quickly enough, and this is becoming a problem. It's always
they're Mac Minis.
Mac Minis? Is that what they're called?
Isn't that what they're called?
There's another one, too, that's like Neo.
Okay.
Neo Mac. I'm really up on my stuff.
Likewise.
This is really great.
Based on this conversation. So we'll move on to other things. We'll talk about energy. Bloomberg's Vincent Piazza with energy giants reporting earnings. Great numbers from Chevron just moments ago, at least on EPS beating expectations. Exxon coming up in just a moment. Plus, Yahira's got your morning movers. Memory stocks slide following an April surge. We'll get into that in just a moment. From New York City, you're watching Bloomberg TV. Full time for the month of April, the final score, check it out, up 10% on the S&P 500, biggest monthly gain since November 2020. On the Nasdaq 100, up 16%, biggest monthly advance since October 2002. Nasdaq futures this morning just slightly softer, down 0.1%. On the S&P 500, slightly positive, up 0.1%. That's the price action for stock markets. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with Apple. Those shares are rising nearly 3% in the pre-market on a forecast that blew past estimates. And make no mistake, Apple making it clear that its last quarter would have been even stronger if it weren't for those supply constraints, especially around memory. And this is interesting. Bloomberg Intelligence saying that dynamic could be what's driving Apple's gains in China as higher memory costs force its competitors there to raise their prices. And sticking with that memory theme, we are seeing the likes of Western Digital and SanDisk down after earnings, even after they delivered a beat and a raise. But the bar was high because Western Digital is up some 130% year to date, and SanDisk up 300% year to date. And we end on Chevron. A surge in oil prices tied to the war helped power earnings there, so shares are up nearly 1.8%. The company blowing past estimates as stronger crude prices helped offset production hits it experienced from the war. Plus, it was helped by that Hess deal and that fast-growing Guyana asset. John.
Yahara, thank you. Thanks for the update. Similar story just from Exxon right now. Similar price action to Exxon. First quarter adjusted EPS 116, the estimate 96 cents. That's another upside surprise.
When you take a look at the numbers here, higher energy prices added $1.7 billion to earnings during the quarter. That's compared to $400 million of a decline from war-related production outages. They estimate that about 15% of their production is offline as a result of some of the conflicts in the Persian Gulf. A question here about how much this market has discounted the boom for a lot of the oil companies in the United States from higher oil prices. We're seeing it in real time right now.
These stocks had great first few months of 2026, then faded pretty quickly. Once this naval blockade started and once the Iranians blocked the Strait of Hormuz, they've done nothing for the last 2 months or so. We'll talk about that in just a moment. The stock is up at a pre-market by close to 2% this morning. Upside surprise on Chevron, similar story on Exxon. On our radar this morning, Apple delivering a stronger than expected revenue forecast for the third quarter. The company warning of increasing memory chip costs and months-long shortages of Mac computers. Elsewhere, the president vowing to maintain pressure on Iran with the naval blockade near the Strait of Hormuz.
Their economy is crashing. The blockade is incredible. The power of the blockade is incredible. They're not getting any money from oil. And hopefully it can be worked out very soon.
Tehran facing threat of exhausting its crude storage space and being forced to cut production. And the president saying he's unbothered by Jay Powell's decision to stay on the FOMC after his term as chair ends.
No, I don't care. If he stays on, he stays on. That doesn't... I just wanted to make sure that Kevin became the head. It's very unusual that they stay on. You know, I predicted he would because, you know, who's going to hire him? He's a negative. I think he's a negative force.
Kevin Walsh is on track for Senate confirmation as the next Fed chair, something we've talked about just in the last 24 hours. Since this announcement from Chairman Powell in that news conference, the administration is not looking for a fight here. In fact, based on the comments we've had, not just from the president, but also from the NEC director, Kevin Hassett, they're backing away and turning down the temperature as much as they can.
So the question really is why? Is this because they want this to go away, they have enough on their hands and they want to deal with that? Is it because they're concerned about the market's response to some sort of prolonged fight that nobody really wins? Or is this just Operation Get Kevin Walsh in there and then we'll reassess? And ultimately, the decision to that will give people a sense of whether this is a pause or whether this is truly a change in tone. And maybe we'll give Jerome Powell the confidence that this might be actually some full and complete transparent end to the conflict.
I can't get in their minds, so I don't know. But it was a mistake. It was a mistake to go after the institution in the way they did when they had the opportunity to reshape it in the way they wanted to. And they've made sure now that someone in the institution is going to make it harder for them to do that, because this is not the situation they had to be in. They could have had a situation where Kevin Walsh was confirmed, respectable candidate, would have been on the FOMC, still going to be on the FOMC by the time we get to June. Plus, they would have had another seat they could have filled with someone they wanted to fill it with.
There were a lot of logical off-ramps where they could have exited stage left earlier in this tit-for-tat between the Fed and this administration. They haven't. That's why, even though you are completely correct, it was a mistake to go after them. It was a mistake to really engage in some sort of legal battle that a lot of people wonder how much merit it actually has, and to stick with it even after there are some discussions around that. That's why this is surprising. Why now?
On the margin, they've made it harder to cut interest rates. That's the ridiculous thing about all of this. Let's turn back to the war in Iran. The president vowing to keep up the blockade, even as the average cost of a gallon of regular gasoline is well over $4 and more than $6 in some states, including California. Bloomberg's Tyler Kendall has the latest from Washington. Hey, Tyler.
Hey, John, good morning. Well, higher gas prices are definitely proving a political liability as we head into the midterms, though this White House maintains that they are highly confident it will only be a short-term disruption, in their words, when it comes to the energy markets. The NEC director, Kevin Hassett, said as much on this program yesterday, but I have to say I was pretty struck by the fact that when Annmarie was pressing him on whether or not the administration is considering any additional tactics to help bring down the price of retail gasoline, he only touted things that have already been done, including that extension to the Jones Act waiver, because at this point we haven't gotten any indication that the standoff over the Strait of Hormuz is easing. In fact, overnight there was this post from Iran's president reiterating what has been a consistent demand that the U.S. must lift its naval blockade before talks resume, calling it, quote, intolerable. But as you mentioned, President Trump touted it just yesterday, saying that the blockade is incredible and that the U.S. will continue to try to squeeze Iranian oil exports amid real questions about just how much excess crude storage capacity the country has. Now, there is this new reporting from the Wall Street Journal that the U.S. is renewing its pitch to allied countries about deploying and joining a joint force naval force to help secure the Strait of Hormuz, but it appears that the sentiment is still the same, that these countries don't want to deploy any additional assets until there is a stronger ceasefire in place. Though, John, when asked yesterday by a reporter about whether he is getting, quote, antsy about ending the ceasefire, maybe resuming the fighting, President Trump says that nobody really knows where the talks stand except himself and a couple of other people.
Tyler Kendall down in Washington. Tyler, thank you. The squeeze continues. 111 on Brent, WTI at 105. Shares of Exxon and Chevron rising in the pre-market. Both companies reporting earnings that beat Wall Street estimates. Joining us now to discuss, Vincent Piazza, Senior Equity Analyst for Oil and Gas at Bloomberg Intelligence. Vince, welcome to the programme. Where have the beats come from? Because the price of crude was higher, but production in some places obviously has been cut.
Good morning. Yeah, thank you for having me, John. So, when you think about the quarter, two things come to mind. Price trumps volume. Volume was down for both, but the consistency of the upstream price appreciation during the end of the quarter definitely had the benefit. But also, the second important thing is the resiliency of the model. Where have Exxon and Chevron invested over the last several years, and that's in North American upstream, and that also is in Guyana. Both of those assets are in more stable, less geopolitical risk in those regions, and so therefore those were an actual benefit to them, despite the turmoil out there in the Middle East. Exxon and Chevron's business models actually shining through, despite the timing differences, the impacts on the upstream side because of the Middle East. The results speak to that resiliency of the overall model.
Vince, one curious aspect of this is some people have been calling for oil companies to increase their production to offset any of the lost barrels in the Middle East. The Financial Times reporting this morning that Exxon and Chevron both have shunned those kinds of calls, saying we're already operating at a pretty high volume, and right now we're in a good place. Do you think that there is going to be increasing pressure for the oil majors in the United States to increase production, or do you think that they're in a good place to really have a good balance going forward?
Yeah, thank you. That's a great question. So when we talk to the companies, whether it's the integrateds or the other independent upstream companies, what we're hearing is that the investor base wants capital discipline, because if you look at the prices farther out along the curve, it is well below the prices that we're seeing today. And so capital discipline, controlled production, free cash flow that goes to the investors in the form of base dividends and buybacks, those are the keys. The investor base does not desire any incremental production growth just for the sake of production growth, because there is still clouds in the air in terms of the demand cadence for the legacy fuels.
What are you looking for, Vince, in terms of assessing the actual damage to assets near Iran, given some of the costs that have been put out there? Do you think that we're going to get a better sense of how long it will take, should the conflict and should the fighting, the kinetic war stop, how long it will take to rebuild and bring these assets online?
So when we think about it, we put it in three buckets: what's been delayed, what's been disturbed, and what's been destroyed. I think the first two buckets have been pretty obvious, that we have had significant delays and disruptions. But from the destruction standpoint, outside of Qatar gas, there hasn't been significant destruction of the actual underlying assets. So we think that in order to ramp up, it probably won't take as long as some of the dire estimates are out there. So I think so far what we have here is a pretty controlled environment. Here for the U.S., the U.S. operators are obviously going to see a net benefit because it's a much more stable environment here. And also, for the most part, we have a much more stable operating scheme for the upstream operators.
Hey, Vince, thanks for breaking it down. We appreciate it. Vincent Piazza there of Bloomberg Intelligence, following the numbers from Exxon and Chevron better than expected this morning. What did he say? Price trumps volume.
Yeah.
Seems to be the story so far. Looking at Exxon and the way it closed at the end of February, we've talked about this theme a few times. Closed at the end of February at 150, 250. Some of these names in the energy sector had massive starts at the very beginning of the year. But through March and April, in total, haven't done much at all. We closed yesterday at 154.33.
Does this launch a change where people realize that price trumps volume and think about the fact that these companies are not boosting production? What's the offset? Some people were speculating, analysts were speculating, that if longer-term oil prices remained above a certain level, say $90, into December, into next year, then all of a sudden there could be an incentive to increase production. We're not hearing that because ultimately they don't want to spend more of their capital. That is the message from shareholders, and that's the message from some of these executives.
Annmarie not with us this morning. You might have noticed that. She'll be back a little bit later. She's having a lie-in. Good for her. She's going to be back later on this afternoon. She'll be catching up with the CFO of Chevron. Look out for that around 4 p.m. Eastern Time. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. Nissan is scrapping plans to produce 2 fully electric SUVs at a U.S. factory. The move is part of a broader rethink of its product strategy as it looks to conserve cash. It also comes as EV sales in the U.S. have been slower than expected, especially after President Trump eliminated tax credits. Meta selling $25 billion of investment-grade bonds as shares plunged yesterday on rising concerns about its AI spending spree. Almost all the 6 tranches were priced at higher risk premiums than at a sale last October. The stock, though, as you can see, is down more than 7% year to date. And as you all were discussing, we are seeing Exxon and Chevron shares trading higher in the pre-market. Both companies reporting earnings that topped Wall Street estimates in the first quarter. Chevron saying higher oil prices helped offset production outages. Exxon saying something similar. That's your Bloomberg Brief. John?
Yahira, thank you. Thank you very much. I would have taken the extra few hours in bed this morning, wouldn't you?
No, I
Have
actually...
we had it confirmed as to whether that was cleared? She was allowed to do that, or just fancied an extra few hours in bed this morning?
I'm working on a full investigative look through.
Okay, you find out.
Yeah, and then
let
we can
us
all,
know. I'm told that Annmarie will be here a little bit later on this afternoon to conduct that interview. So,
I mean, what kind of
looking
questions
forward to that appearance.
We could have all. Would you have wanted that? Well, I mean, would you like candy and rainbows?
Yeah, absolutely.
Correct.
I wanted what I wanted to do. Not that it really matters what I wanted to do. I wanted one of those things behind the bed, like just a massive TV with this, right? And then just have a camera there just to sit up in bed.
I would pay for that. Would
just
you wear
do
your
the
tie?
show down the barrel for 60 minutes.
Oh, tie.
I sleep in this Bramo, ready to go, obviously.
Clearly.
Up next on the programme, supercharging the US economy.
It's really strong data. We got initial claims, the lowest they've been since the 1960s. We got government employment, the lowest it's been since the Second World War. We've got all these positive movements. Getting interest rates down could really supercharge the economy.
Up next, we'll catch up with Abigail Watt of UBS from New York City. You're watching Bloomberg TV. Welcome to May. Equity futures positive by 0.1% on the S&P 500, on the Nasdaq down by a similar amount. In the bond market, want to turn to fixed income. Bring up 2s, 10s and 30s and just look at 2s. 388 on Tuesday this morning, up a single basis point. So that's above where Fed funds is. This market has decided this Fed is going nowhere, and there's a small risk they might have to hike. This is the view from Mike April and Morgan Stanley. We now expect the Fed to maintain a hold for the rest of 26. Deutsche Bank's Matt Lazzetti, the policy rate is likely to stay unchanged this year. BNP Paribas agrees. We expect the Fed to stay on hold into 27. But James Egelhoff over at BNP says this: we see a growing tail risk that policymakers could hike this year if the unemployment rate declines and the Strait of Hormuz remains closed.
We've had him on before and asked him about this and said, what about the political pressure to cut rates? And he said, well, yeah, this is stripping that out. So, the one thing that the market is baking in is a dovish predisposition of the Fed chair coming in because of the administration that will shun any thought of a rate hike, even if there are a couple of economic conditions that make it through.
If you go through the year and you've got Brent at 111, WTI at 105, and let's say that stays with us into the fall, into the back end of 26, and you've got jobless claims like the ones we saw yesterday and an unemployment rate that stays closer to 4 than it does 4.5%, you wonder where that would leave inflation in this country and how this Fed might respond to it.
I'm watching the back end of the yield curve. This is the answer to that conundrum. If you see a yield curve steepening that starts to really exert itself over this economy, do you get a Fed willing to hike rates? Or, to Kevin Hassett's point yesterday, do they start looking at things like the balance sheet to really work with some sort of Treasury Fed accord to change the dynamic a little bit?
Under Savannah's this morning, supercharging the U.S. economy.
It's really strong data. We got initial claims the lowest they've been since the 1960s. We got government employment the lowest it's been since the Second World War. We've got all these positive movements in terms of fiscal responsibility and economic growth moving forward. And so then, but we do have this temporary disruption with energy markets. Getting interest rates down could really supercharge the economy from where we are, but not be super inflationary.
So here's the latest this morning. The U.S. economy showing signs of strength despite surging energy costs. Abigail Watt of UBS writing, we expect that spending should still be a little stronger in the second quarter, but will depend on the offset between higher gasoline prices and tax refunds. Abigail joins us now for more. Abby, welcome to the program. Is this economy in a position to support higher prices?
Good morning. Thank you for having me. So I think it's a really interesting point to raise, right? I think when we look at the data that we got yesterday, I think it's totally fair to say that we had a relatively strong nominal increase in spending in March. But if you looked at kind of real spending, it was actually down 0.1% over the month when you consider that strong inflation impulse through the March period. And I think when you look at the kind of fundamentals for the consumer, I think they look relatively different depending on where you're sitting in the income distribution. One of the things we've seen in that kind of personal income and outlays report kind of consistently is you've essentially seen kind of slowing real disposable income, kind of okay pace of real spending in kind of annual terms. But what you've seen is the saving rate dipping lower, right? So yesterday the savings rate dipped back down to 3.6%, the lowest it's been since October 2022. And so I think with inflation pressures, I think the distribution of that's going to be different across the income spectrum. And I would say that what we're seeing at the minute is kind of a wealth effect potentially keeping consumption going, despite some of the slowing we did see in the numbers yesterday.
So what does that mean for the second half of this year, Abby, with that in mind?
So I think, one of the key things coming into this year, obviously, was that you could potentially have a little bit more support for the consumer from tax policy, right? I mean, we've seen a relatively significant rise in terms of tax refunds flowing to households are up kind of 15 to 20% versus kind of where they were at this point last year. And I think that's something that helps kind of that buffer, right? I think that buffers a little bit some of this kind of energy price shock that we're seeing through the second quarter. And so with that, we've basically got kind of the strongest quarter of consumption growth happening in this quarter, and then I think a little bit of slowing into the second half of the year when you see kind of some of that kind of some of the energy price kind of feeding through, and you also see some of those tax refunds essentially being spent away by the lower income households essentially.
Abigail, do you think that this is a labor market that's in stasis or shows signs of reaccelerating based on some of the initial data from the likes of ADP and the initial jobless claims?
Yeah, so I think it's really challenging at this juncture to get a really good sense of the labour market. Obviously, the kind of establishment survey data have been incredibly volatile through the first couple of months of the year, just given the kind of change in the methodology that's being used by the BLS. We've also seen in the unemployment rate, it's a little bit hard to get a read because, you've seen some shifts in terms of the labour force participation rate. With that shift in participation, if you were to hold that stable, the unemployment rate would have actually risen to 4.5% rather than kind of fallen back to 4.3. So I think it's a little bit challenging to get a good read just now. But I think it's fair to say that, we haven't seen necessarily a shift higher in initial claims or continuing claims. You've seen relative stability. Obviously the print this week in initial claims, there was quite a drop within the week, but these can be quite noisy from week to week. And so when you smooth through, I would say they're signaling a labour market that's showing relative signs of stability, not necessarily weakening at this juncture or not necessarily significantly improving at this juncture is how I would read those data.
Taking a step back to tie it all together, Abigail, there's a real debate right now about how much people are starting to see the nodes of some sort of cyclical recovery in the underlying economy and how much we're just seeing AI spend overwhelming absolutely everything and distorting all signals. Which do you think it is?
Yeah, so I mean, the data that we got yesterday, the Q1 GDP data, I think the composition was really interesting. Obviously, we're continuing to see that slowing in consumption, a 1.6% pace of consumption in Q1 versus 1.9% in the fourth quarter. And I think the real standout yesterday, as you're noting there, was the equipment side of the accounts, the investment side. And when you look at the investment that we're seeing in the US, it is relatively narrowly driven in terms of that tech, AI, CapEx spend out. And I think, the data that we got this week in terms of the core durable goods report, that would be consistent with that potentially continuing. We had expected that you would see a little bit of a broadening out, I guess, in that investment dynamic this year because of the expensing provisions in the Big Beautiful Bill Act, potentially meaning you see a little bit more traditional CapEx coming through as well as that kind of ongoing tech CapEx. And I think you have seen a little bit of a broadening out in terms of those durable goods orders. But I think that's something that we'll be watching just to get a sense of whether we see kind of a broadening versus kind of this just ongoing AI tech theme, which really, was the standout in yesterday's GDP report.
Abby, thanks for being with us. It's good to see you, as always. Abigail Watt there of UBS. That's been the story coming into 26. Rate cuts in the pipeline. CapEx from some of the biggest companies on the planet. Tax refunds too. That's insulating this economy from the stress in the commodity market.
We keep going back to at what point is it then inflationary? We had Kevin Hassett saying that it wasn't going to be inflationary because of productivity from sort of the artificial intelligence. Are we hearing that, though? Or is this the idea that potentially people can absorb higher prices because of the wealth effect, because they're earning more money, and because they are getting tax refunds, and that ultimately maybe is what you're seeing in some of the underlying data?
We played this game in 24, in 25. What's happening with inflation is the Fed on hold. What's happening with inflation is the Fed on hold. Then unemployment bit. And then at the end of 24, they cut rates. At the end of 25, they cut interest rates. There's a sense, and you can feel it building just in the consensus right now, that this feels different for a lot of people.
In terms of the sustainability of this inflationary push, there has been a game change. And when you start to talk to analysts, I was thinking about Bob Michael, who came in, buy bonds, there's a shortage of bonds. And then you start asking, do you buy long bonds here? And he said things have changed a little bit with respect to what's going on with the oil prices, the Strait of Hormuz. Wait and see is the mode that everybody is in. Who is the forward indicator for that? Maybe the Truth Social feed coming from President Trump.
Bob Michael has changed his view a little bit. Neil Dutta has changed his view a little bit. Governor Waller has changed his view a little bit as well. It's notable. The names are building.
Yeah, when you have a fifth of the world's oil shut in and other supplies, well, things change.
Up next on the programme, Victoria Fernandez of Crossmark, Ed Mills of Raymond James, Shahmir Khaliq of Citi, and Amanda Lynam of Goldman Sachs. The second hour of Bloomberg Surveillance. Up next.
For the most part, the economy is in a very strong trajectory.
The U.S. still has the most dynamic, most sort of innovative economy.
People continue to underestimate that.
We really have reoriented this economy towards very strong CapEx.
For right now, you have to kind of tip your hat to the economy and say things are stable.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It's a quiet start to May. Let's hope it stays that way. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your price action scores look like this. Equity futures this morning, muted gains up by about 0.1%. What a run through the month of April, higher by 10%, the biggest monthly gain since 2020 on the S&P 500. You've got to go back 20 years plus for the NASDAQ 100. The biggest monthly gain on the NASDAQ 100 going back to 2002, a 16% advance on the NASDAQ through April. That's the scores in the equity market. This is how things are shaping up in the commodity market this morning. Brent crude, front end of the futures curve. We're now talking about July. Just bear that in mind. 111 for WTI. We're still talking about the month of June at 105 this morning. Brent crude up by about 0.7%. And with crude still being elevated, this is the move in the bond market. Yields are as well near the highs of the year, close to 440 at 438 on 10s.
You can't underestimate the strength in earnings and the strength in corporate America, given the fact that we just saw the best monthly rally since 2020, as you mentioned, even with yields going higher, even with oil prices going significantly higher. It just shows a resilience that really underpins the lack of attention that people have paid to it. Rajadhyaksha of Barclays really summed it up well. Is this the market just shrugging things off? Is it the earnings being so great? Or is it also that the oil ramifications really haven't hit yet, that ultimately the first 3 weeks were not necessarily felt in the physical world in the same kind of way because of the floating oil and because of the supply glut that people hadn't taken into consideration? How much does that change in every consecutive week going forward?
The tankers were still arriving. The inventories were large. There was a cushion there. So in Ajay's mind, it's not that the situation in the Middle East didn't matter. It just didn't matter yet. And first and foremost, what did matter to him was the earnings profile in the United States. And earnings have been fantastic in certain places. Now he thinks that maybe it will start to matter. So this is an interesting call coming from the team at Barclays, because they've been bullish off the low of late March, upgrading their price target on the S&P 500, and now they turn a little bit more neutral, because the longer this blockade goes on, in their minds, they believe it starts to bite.
A number of analysts say that they're going to start to worry a little bit more when the oil majors start performing more successfully in markets. They haven't been really doing anything. You've pointed this out many times. And yet Chevron and Exxon reporting earnings today highlighted how we were just hearing the price trumps volume. And when you look at the likes of Exxon, with a $1.7 billion increase to their budget as a result of higher oil prices, despite the $400 million hit, you see how much some of the losses are offset. If they do better, is that problematic for the rest of the index?
Mike Wirth over at Chevron is the guy I always listen to. The global energy system is under extreme stress. His words this morning. Demand must come down if supply is not re-established, and right now supply is not being re-established. So where does it leave the central banks? So this week we heard from the Fed, the BOE and the ECB. The Federal Reserve very close to dropping its easing bias. It's getting closer. The Bank of England open to hiking interest rates sometime soon, just not quite there yet. The ECB, out of the three, arguably closest. There feels like there's a real consideration, listening to the guard through that news conference yesterday, that June is very much on the table.
Yeah, it just seems like there needs to be a reason not to, for them to ultimately make that move. June right now very much priced in for the ECB, despite the fact that analysts here say it'll be a policy error, considering the fact that growth is slowing. Nonetheless, highest yields in the Eurozone since 2011, the UK since 2008, Japan since 1997. You put this all together, you know, at what point does that crimp some of the dynamism that we're seeing in the earnings and corporate story?
Futures right now positive by 1/10% on the S&P 500. Coming up this hour, we'll catch up with Victoria Fernandez of Crossmark Global, with equities hitting fresh all-time highs. Ed Mills of Raymond James on the standoff in the Strait of Hormuz, and Amanda Lynam of Goldman Sachs as hyperscalers unleash record debt. We begin this hour with stocks holding steady, closing out a week of strong tech earnings. Victoria Fernandez of Crossmark Global writing, our theme for the year is high-risk bull market, and earnings seem to be telling us that the bull component of that statement is holding true. Victoria joins us now for more. Victoria, welcome to the program. Decent earnings in many cases. Does that insulate this stock market from additional pressure from elsewhere?
I think it does, at least for the time being, but you're still seeing a market that's a little jittery. I mean, look at SanDisk, right? Great earnings, knock the cover off the ball, and the stock is down this morning. So the market isn't necessarily going in and rewarding everyone because they have good earnings, but it's the fact that the earnings are good, that people are meeting expectations and even exceeding them in some cases, that continues to give a little bit of momentum to this market. And I think your conversation is spot on when you're talking about some of the elements that just haven't hit the market yet. When you look at the buffer of the tax situation, higher gas prices have taken out about 12 to 15% of that tax buffer right now. So the longevity of how long this Strait of Hormuz is closed could eat away at that pretty quickly. And then I think you start to see sentiment turn. But for now, earnings and capex are really driving this market.
Average gasoline prices in this country now pushing $4.40 a gallon. Victoria, do you believe that's a growth story or an inflation story?
Yeah, I think for now we see it as an inflation story. Consumers are only going to be able to pay higher prices for so long. And again, they have a little bit of a buffer right now that will get them further along. We saw spending up 0.9%, but incomes were only up 0.3%. So how long are they willing to do that? When you look at the companies, the oil and gas companies saying they need demand to come down, it wouldn't take long for demand to come down if we continue to see those prices move higher and we don't see incomes move at the same pace. And obviously, if we get central banks starting to raise rates like you were talking about, I think the ECB whisper talk is maybe 2 hikes through the rest of this year. Then you definitely get that demand coming down, and that will bring inflation down with it. But for now, I think you're going to have stickier inflation.
John started the show saying that we're about 7 hours into May, and it seems pretty calm. And so hopefully it'll stay that way. And I almost laughed. I did laugh because ultimately it's been such a tumultuous ride. And one thing that people keep saying is you don't get a full read on anything. There's no way to get an edge on the news flow. What is the canary in the coal mine for a shift in the tone where earnings can be independent of some of these macro trends?
Yeah, so earnings in itself, like I said, are not really feeding through in terms of just because a company does well, the stock is going to do well. We have examples of that. What I think is really feeding through is the capex component. So capex has been huge. When you look at the GDP number, you're seeing analysts say about 1.5% of the 2% growth for GDP came from capex. It came from that industrial complex, the non-residential investment component. That's where we're seeing a lot of things grow. And I think that's going to be what drives us forward. So we're going to be watching those elements very closely. It's one of the reasons I think that you're seeing things like agriculture breakout. You're seeing industrial metals outperform precious metals because the discretionary part of the market really is not doing that great. There's certain elements of it, but discretionary itself is back to kind of where we saw in the beginning of the year where it's not doing wonderfully. So I don't think we can make a blanket statement about the market. I think we have to look at very specific components, what's driving the momentum right now, and those are the areas that you want to look at investing in.
If the Chevrons and Exxons start outperforming again, is that a warning sign for the rest of the non-tech market?
It's difficult to say. And obviously, sitting here in Houston, I love to see these companies do well. I like to see their cash flows increase. But you also don't see these companies going out and doing drilling and doing new projects. They're really just kind of sitting on hold because, as you've heard the CEOs some this morning even say, this can change pretty quickly. So they're not going to make big decisions and do things that will affect their balance sheets without knowing how long some of these elements are going to be in place. So I don't think it's necessarily a growth story here. I think we're looking at a market that is weighing a lot on earnings and capex. They're concerned about what's going on in energy, but they're in a wait and see mode, not ready to make decisions based on that yet.
Let's stay with capex and let's pick out 2 names, 2 very different stories this week, Meta and Alphabet. Meta down yesterday by close to 9%, Alphabet up 10%. Both of them are spending a lot of money. What's the difference between the two right now? And are we reaching the limits of this capex boom?
Yeah, you know, I'm not sure we are reaching the limits. Unfortunately, it makes me very nervous when I see these numbers continue to go higher. But I think the reason we had a difference between those two companies, there's concern around Meta's revenue and the monetization of the capex that they're putting to work. Whereas when you look at Alphabet, you're already seeing some of that come to fruition. Plus, Alphabet has their cloud business up 60%. I mean, I think that was one of the strongest components that you saw for Alphabet. Plus, you saw paid subscribers go up. You saw their backlog double. So there were a lot of elements there at Alphabet that continue to have it as one of the leaders. It's the area where we're overweight in the Mag 7 along with Apple, where we're underweight when it comes to Meta. And I think it comes down to that monetization and do they have the revenue in order to do the capex they're talking about. We saw Meta come to market with what, a $25 billion bond deal this week. So that makes people nervous.
Yep, and a big order book too. new of about 96 billion. We'll talk about that order book a little bit later this hour. Victoria Fernandez there of Crossmark Global. Victoria, thank you. The performance, the spread of the performance through April across some of these names. Apple up 7%, Meta up 7%, Microsoft up 10%, Amazon up 27%, Alphabet up 34%. Last month.
Yeah, you see who's gaining share and who's actually exceeding expectations when it comes to growth rates. Google had been left for dead, and people said OpenAI would eat its lunch. All of a sudden, not so fast. We've got Gemini taking over, and frankly, they're keening on the cloud computing side as well. Amazon, meanwhile, turning to become a chip producer. People are getting very excited. Meta, a question mark. What are they spending on? Do they have a clear vision? They're cutting staff. They're seeing demand go down for their advertising. People feel a little more sketchy. Still, $96 billion order book for a $25 billion deal. I'm not exactly crying for them.
It's just not 125, which was what the order book was last time for the 30 billion offering.
Right, so it's actually waning demand, and so maybe this is a warning sign that,
It's fatigue building.
Yeah, that's correct.
We'll ask Amanda Lynam later this hour. She joins us from Goldman. She'll have her own views on that situation in the credit market. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. President Trump says he's sticking with a naval blockade of Iranian ports. His comments coming after oil hit a wartime high. Iran's new supreme leader also casting doubt on the likelihood of a deal, vowing not to give up the country's nuclear or missile technologies. NVIDIA and Microsoft are signing deals with the U.S. Department of Defense to expand the use of AI on classified military networks. Sources telling us here at Bloomberg. The Pentagon is also looking to strike a similar agreement with Amazon Web Services. And Jane Street's pay pool more than doubling to $9.4 billion in 2025. Sources telling us here at Bloomberg that the market maker brought in about $40 billion in trading revenue last year, putting it ahead of Wall Street banks and many of its peers. That's your Bloomberg brief. John?
Have we lost Annmarie to Jane Street?
How do I get a job at Jane Street?
Application. You
Yeah,
ready to go?
Please write my application.
They can't afford you, Bramo.
Oh, right. Oh, yeah.
No way.
Oh, thank you.
No way.
That's so sweet. That's your pitch.
Up next on the programme, keeping the pressure on Iran.
Their economy is crashing. The blockade is incredible. The power of the blockade is incredible. They're not getting any money from oil. And hopefully it can be worked out very soon.
Up next, we'll catch up with Ed Mills of Raymond James, live from New York City this morning. Good morning. Stocks, a bit snoozy this morning, firmer by 0.1% on the S&P, on the Nasdaq down by 0.2%. Breaking down the month of April, energy stocks trading lower on the month, discretionary on the S&P, up by double digits. Decent gain there, despite this move in crude. Brent WTI, Brent crude, still triple digits here across the board, 111 on Brent crude, and up by 0.8% so far this morning. And the longer dated prices, say the December contract, they've been making new highs throughout this week.
There are two theories. On one hand, that the actual pain hasn't really hit. The second one is that the U.S. economy is resilient enough and strong enough, and the consumer wants to spend enough, that this just isn't a problem. And which is it? And ultimately, the answer to that will decide the fate of some of these consumer discretionaries and, frankly, the optimism in U.S. economic strength despite the increase in oil prices.
And more verbal intervention from the Japanese. This time not the FX market, but the commodity market. And if you're just joining us and you missed this is the quote from the Vice Finance Minister for International Affairs. Generally speaking, we are always ready to act regarding crude oil futures transactions.
That feels like somebody standing in front of an oil tanker and trying to push it back. I mean, at what point do you not want to just burn money, given the fact that you can't really fight the groundswell of concern about higher oil prices, and at some point you are going to get wiped out? So I understand that Japan is a big economy. I just wonder, for all the people who say this is a manipulated market, it could be, and people were thinking about that. It's a pretty big market to be manipulated for that long, and it's pretty expensive.
I respect the threat, the willingness of Japanese authorities to manipulate markets.
Do you? Do you
To
now?
the point that they are no longer markets anymore.
Are you buying an ETF in Japan?
In certain cases, we saw that in the JGB market over the last decade.
Yeah,
Which is why people take threats like this seriously, because they've shown a willingness and ability to follow through on some of these things.
Arguably, JGBs are a bit more of a closed market than, say, oil.
I would agree with that.
So potentially that might be a little bit more problematic. Nonetheless, I'm glad that you appreciate
that for lots
their...
of people, I know we've got to move on. There are some people that think some funky stuff has been happening in the futures market
Every single person.
over the last 2 months.
Every single person who's come on, when I've asked them, they say, well, yeah, look at the trades. I mean, there definitely has been. At the same time, it hasn't been enough to push prices lower the longer this grinds on. At a certain point, it does become a freight trade. And that maybe is what we're seeing in the December contract.
111 on Brent this morning in the July contract. Under surveillance this morning, keeping the pressure on Iran.
Their economy is crashing. The blockade is incredible. The power of the blockade is incredible. They're not getting any money from oil. And hopefully it can be worked out very soon. The gas will go down. As soon as the war's over, it'll drop like a rock. Despite the fact that we are in what some people would call a war, we just hit a new high today on the stock market.
So here's the latest this morning. President Trump vowing to maintain the blockade on Iranian ports. Tehran insisting it must be lifted before new talks can occur. Bloomberg's Tyler Kendall has more. Morning, Tyler.
Hey, John, good morning. Well, President Trump maintains that it's fractured leadership in Iran that is making the negotiations so difficult. And he says that the U.S. still wants to pursue the diplomatic options. But at this point, and as you mentioned, the sticking point seems to be that Iranian officials have been pretty consistent that they don't want to resume talks until the U.S. lifts its naval blockade. And in the latest sign that that's not happening, a senior administration official tells us that the U.S. Department of Justice has initiated the forfeiture process for 2 Iranian-linked oil tankers that were seized by U.S. naval forces just the other week. Now, it's unclear what this will entail, but it's something to watch because it could signal intent to seize the oil cargoes on board in what would be considered an escalation. Because at this point, Axios is reporting that President Trump has been briefed on an array of potential options, including maybe even a short wave of strikes to help try to break the deadlock that we're currently in, because Iran is still maintaining its hardline position. In fact, we got a statement from Iran's president overnight calling the U.S. blockade, quote, intolerable. But John, when asked yesterday about whether or not President Trump is getting what the reporter called, quote, antsy about ending the ceasefire if we could see a resumption when it comes to the fighting, the president maintained that no one really knows where these talks stand except for himself and a couple of other advisors.
Tyler Kendall with the latest in the nation's capital down in Washington, D.C. Tyler, thank you. Ed Mills of Raymond James writing this. Any diplomatic path forward will likely be rocky and have to take the form of a near-term framework that allows both sides to claim victory. Ed joins us now for more. Ed, welcome to the programme. At times, this has been messy. That's inevitable. We've asked the question whether this is strategic ambiguity or just the lack of a strategy. Do you think we have a decent idea of what the strategy is now?
Well, John, I think the biggest concern that I have is right now both sides feel the other one wants to get this over quicker, and both the United States and Iran think that they have the upper hand. And so unless someone feels this pressure, the Straits of Hormuz are not reopening. In the kind of back and forth here, is it the oil price? Is it the price at the gas pump here in the United States? Is it political pressure on Trump? Or is it the fact that the Iranian economy needs to move things through the Straits? They have more than 150 million barrels of oil on the water. They have oil wells that are about to get shut in. Who moves first is really the question that I'm getting the most here at Raymond James.
Ed, how would targeted strikes accelerate the process by the U.S.?
I think, the hope there, Lisa, is that it is going to just force it, that there is going to be that threat, that something has to move. And I think from a market perspective, I think the debate here is, are targeted strikes a signal that the kinetic activity is about to really ramp up? Or is that the push that finally reopens and gets us back to the negotiating table? My bet is the immediate market reaction would be the kind of fact that they think that this could reopen things and this could be the catalyst to those talks restarting. So the hope I have is that even with additional kinetic activity, the market holds in there. The kind of risk there is that it actually kind of goes further south before we get any sort of solution.
And how does the deadline of 60 days calculate in this whole equation, given the fact that ostensibly the administration would need to seek congressional approval to continue the conflict beyond that?
Yeah, so there's two things there. Under the War Powers Act of 1973, there is this 60-day deadline. What we heard from Secretary Hegseth yesterday is that the Trump administration doesn't think that they are hitting that 60-day deadline because of the ceasefire. And under this, there's also a 30-day ability to kind of withdraw troops. However, we have seen presidents in the past violate this deadline. after 60 days, you are supposed to get the congressional authorization. But you go back to the Obama administration. You actually had the House of Representatives vote to end activity in Libya because they were well beyond that 60 and 90-day period. The Senate never took that up. They tried to go to the courts. The court said, you know what? It's Congress's job. So right now, it is a political issue for the Trump administration. And unless you have a veto-proof majority in the House and the Senate, this law does not get enforced.
In 2 weeks' time, there's a meeting with the Chinese leader. And initially, when that date was set, when the original date was pushed out to the middle of May, people looked at the calendar and said, it will be over by then. Is that date important anymore?
It's very important because you have the number one economy sitting down with the number two economy. We don't have a huge expectation that there's going to be big deals that come out of the Trump and Xi meeting. There is a view that that could be some pressure, but there is growing questions that I'm getting here at Raymond James is, does this get pushed off again? We have not seen the staff level negotiations. Besson and Greer have not met with their counterparts. And unless you have that fleshed out activity before the meeting, you're not going to get real deals into this meeting. The other big question I've gotten here at Raymond James is Xi, who said that this war is upsetting the world order, come in and try to be a bit more aggressive with President Trump. But the risk there is that President Trump never stays on the defensive. He goes on the offensive. And if we have an escalation in the trade war with China, if we are questioning what's happening with tech restrictions on semiconductors, if we're questioning what's happening on critical minerals, those are not positive headlines. I don't think we get there, but that risk is absolutely present over this next 2 weeks.
Ed, are there any signs of that so far? I've been struck by some of the commentary on corporate calls. I'm thinking of Apple in particular, and Tim Cook talking about how things are actually getting better in China, and they actually reported a better than expected sales in China. Do you get any sense that the relationship is becoming more tense, or do you think that we're entering a period of both sides wanting calm?
Yeah, so after the October meeting between Trump and Xi, he gave an order, President Trump gave an order to the administration, stand down. Do not do anything that pokes China, which has given this opportunity to de-escalate. There's been conversations with companies like Apple. Can they work with a couple of Chinese companies to develop deals on memory, because those have been very expensive products. Those are openings. Tim Cook has had a great relationship with President Trump since the beginning of this second term. But if you see this kind of shift, and if she wants to make this change because they hold a number of things that we need to run our economy, he could get a little bit more aggressive. Now, the United States holds plenty of things that China needs to run their economy. It's just more of that personality-driven decision-making as we go into this discussion here kind of 2 weeks from now that can dictate that. And I guess the one warning I'd have is that we've seen in the past, China will escalate right before the meeting to be able to de-escalate during the meeting. Trump's able to come out of the meeting and say, I won these concessions that China had threatened. That's what we did in October. Will we do it again here in May?
Looking forward to that dance if it happens later on. And thank you, sir. Ed Mills there of Raymond James, wonderfully framed for a meeting that takes place in a few weeks' time. Remember, it was going to be a diplomatic embarrassment? Language like that, right? Which is why it was delayed originally?
Yeah, and if it gets delayed again, how terrible. And now it's sort of like, yeah, what's the point? Let's just move it all around.
Coming up on the programme, Shahmir Khaliq of Citi. As the Iran war reshapes global trade, plus Danny's got your morning movers. Moderna flying in the pre-market, higher by 7%. Equity futures shaping up as follows this morning on the S&P 500, positive by 0.1%. What a run of gains through the month of April. Let's go through the scores once again because they're absolutely phenomenal. Before we move on too quickly, up 10% in April on the S&P, biggest monthly gain since November 2020. On the Nasdaq, up 16, biggest monthly gain since October 2002. And for the semi-index, the Philadelphia Semiconductor Index up by 38% in April, and the biggest monthly gain we've seen going back to 2000, the year 2000.
Given the fact that we've seen gains like that, it is shocking to know that bonds didn't cooperate, oil didn't cooperate, the downside surprise and economic growth didn't cooperate. A lot of things didn't cooperate to make this happen. One thing cooperated, and it was big tech earnings and broader earnings in general. And at what point does that get crimped by some of these other aspects? That's the debate heading into May. You're hoping it'll be a really non-momentous May, quiet, we'll all relax.
I'm hoping today's quiet, just into the weekend. I don't mind if the rest of the month is crazy. I welcome that.
You welcome that?
I've got a bias for volatility.
You're going to get hate mail because people are like, listen, I just want Sunday nights to be nice.
Any journalist in our world that says they're not long volatility
I know.
is a liar. Okay? That's what they want. It makes it interesting.
Or
they don't
fear,
want it boring all the time.
Or fear, and then, they feel like
fear
they just have to...
I don't need. Just excitement. Whether you find scary things exciting or not is,
your own bag.
I am a beholder of all
Anyway,
of that
I think it's going to be a really interesting month. I'm excited for this one.
I agree with you. Okay, let's turn to crude. Brent and WTI shaping up as follows this morning. On Brent, just bear in mind, the front month of the futures contract is now the month of July. So we're not really comparing apples to apples here. WTI is still June. WTI is at 105, Brent crude's at 110. Still elevated really across the board and across the curve. And I think that's how the story's changed. Never mind the front month. We've talked lots about how things would really kick in at the back end of the year. Crude prices would drop, deep backwardation, all that stuff. Really, the opposite has started to happen. We're talking about the long end of the futures curve, the longer end, making new highs throughout this week, and that gets your attention.
The December contract for Brent is almost $90. The December contract for WTI is about $80, a little bit north of that. We're looking at this sort of steady creeping higher. So even if the Bank of Japan or the Japanese authorities want to come in and try to manipulate the long-dated curve of oil, good luck, because a lot of people are taking a look at some of the physical shortages and saying it's just a matter of when. And ultimately, it is a slow-moving train wreck that a lot of people have their eye on.
This could be keeping bond yields elevated throughout this morning. 2s, 10s, 30s. 30-year yields up by a single basis point. 10s up by one as well. 438 on 10s. So 440-ish is like the high of the year right now. We're right there on 10s. And to your point, you said it earlier, over in Japan, yield close to the highest yields we've seen since the 90s. The UK 2008, Germany 2011. Pretty elevated stuff in the bond market.
You have inflationary pressures. You have questions about fiscal spend to offset the consumer pain as a result of higher oil prices. And you have a real concern about investing in the physical world and where that money is going to come from. All those three things come together. A lot of people are saying, as Rajadhyaksha said, I wouldn't touch it with a 10-foot pole.
He's not alone.
I know.
Which is why yields have been drifting higher. 10s right now at 438. It's funny, isn't it? People were lining up at the end of the month of May, saying that we'd created value in the bond market and they wanted to buy yield. This was a great opportunity to lock in some income. I don't hear that quite as much as we did a month ago.
The situation with the Strait of Hormuz has been a game changer. We've heard that time and time again from people. Neil Dutta is the perfect litmus test. He was so gung-ho about how weak the labor market actually was and the need to cut rates, and now we're talking about him saying that this is a Fed that should remain on hold. So go figure.
Neil Dutta's changed, Governor Waller's changed. Went through those names this morning. There's been a shift. 10s this morning, 438 up a single basis point. On our radar this morning, Chevron and Exxon rising in the pre-market after reporting earnings that beat estimates. Chevron saying higher oil prices helped offset production outages. We'll catch up with the Chevron CFO later on this afternoon at 3:30 Eastern Time. Annmarie will finally get into the office a little bit later. Just didn't make it this morning.
Yeah, well, I won't make it Monday, so.
You're going to be here Monday?
No, I'm going to lie.
Oh, you're going to have a long weekend?
I'm going to have a long lie.
Good for you.
Okay, let's move on.
You've earned it, Bramwell.
Thank you. Oh,
all
that's
right.
so sweet.
Let's turn to OpenAI. The CFO, Sarah Fryer, pushing back on concerns about missing internal targets. Fryer saying the company is meeting objectives and seeing a, quote, vertical wall of demand for its products. And finally, Meta, planning to shrink its teams and develop new apps as AI shifts the company's workflows. The Wall Street Journal reporting the CEO, Mark Zuckerberg, saying the move won't necessarily mean more layoffs. Meta falling 8% on Thursday after raising its capex for the year. And the story this morning is not really improving too much.
No, because on one hand, there's a question of what exactly its strategy is, whether it potentially could have layoffs. It's saying anything remains on the table, but also saying that recently the trajectory for our business is still very strong. But what you have seen is a real shift downward in terms of the flow in advertising as a result. And he blamed what's going on in the Middle East. So people are looking at this and maybe getting a little bit skeptical.
Well, let's talk about what's happening in the Middle East right now. The stalemate in the Strait of Hormuz is reshaping global supply chains. Shahmir Khaliq, the city head of services, writing for corporates, the challenge is cumulative. Predictability has declined and more capital is required up front simply to move goods reliably. Shahmir joins us now for more. Shahmir, good morning.
Thank you so much. Thank you for having me.
Welcome to the studio. Thank you for being here. Yeah. Just in time used to be the way business was done.
That's right.
We've been doing that for decades. Globalization really helped encourage all of that. Things have changed, haven't they?
Things have changed materially. And I would say, if you just step back and think about not just what's happening in the Strait of Hormuz, but also what's been happening since the start of the year, last year, with tariffs coming through, having an impact on company supply chains and how they go out and sell products across the globe. Secondly, as you think about what's happened to rates, rates have generally stayed elevated. We were expecting to see more cuts in the, particularly in the US, come through. We haven't seen that yet. And generally inflation. So as you think about this triple whammy of effects, we're seeing companies really basically stepping back and saying, how do I think about my supply chain? How do I think about my working capital cycle, my cash flow, and make sure I'm running an optimal business cycle? And therefore, at least from where we're sitting, we're seeing a lot of the companies move from just in time to thinking about production resiliency. When you go there and you talk about production resiliency, that by definition means you're going to run a far more expensive and a far more diversified supply chain and a far more resilient supply chain. So what that means is higher expenses. And companies have to therefore think about what that incremental cost, how that factors in, and by definition has an effect as they sell their products or services down the line.
Let's spend some time on that. When you shift from one to the other, how do financing needs change?
Yeah, I think very clearly, right? So if you think about, first and foremost, you think about your suppliers and the goods that you put into your production process. First and foremost, are you going to use the same suppliers? Do you have to onboard new suppliers? Think about new production facilities. You have to go out there and basically assess the strength and resiliency of the new supply chain that you're building out. So that takes time, that takes assessment, and that obviously needs CapEx on both sides of the house, both on the supplier side and on the company side. And then separately, as you think about how that supply chain then moves through your production processes, you have to potentially retool production, think about moving your production and moving potentially near-shoring it to where your actual client demand lies. So all of that disruption is causing some of these significant moves that we're seeing. And by definition, higher oil prices, that is another higher cost of input. So we're seeing a lot of major change happen in a very, very short period of time.
Before 2020, people said it took a long time to change supply chains.
Yeah.
And that was one reason why there was a stickiness to some of the suppliers.
Yeah.
How much has that process sped up?
I'd say significantly. I think companies have become far more resilient and far more agile in how they think. Clearly, technology has helped. But I would also say companies have been on this journey for quite some time now. And that's why what we're seeing, if you look at global trade flows are up about $2.5 trillion on a year-over-year basis. Trade flows are holding up really well. But I would say within that, I think there are pockets. You think about the AI boom and what's happening in the world of AI and all of the data centers and the supply chains building up to actually cater to that need. Couple that with also, I could give you a few more sectors, the automotive sector, the tech sector, the consumer sector, the healthcare sector, all have seen varying disruptions. And I would say a real focus on building out a supply chain which is far more resilient to helping execute the production agenda that those companies have.
There are frictions traditionally in the banking industry.
Yes.
It takes time to transfer money. It takes time to change some of these flows. It takes time to identify all of the vendors involved. Yeah. How has that changed, and in pretty dramatic fashion, over the past couple of years to meet the changing demands?
Well, it's a journey that I would say the entire banking industry is on, but Citi in particular, the business that I run in managed services, we've been on a mission to actually think about 24/7 as our mission. So as you think about our payments platform, our liquidity platform, and trade platform, the one principle we've lived by is saying, how do we make this payment execute much faster? How do we make liquidity and financing available to support that payment, whether it's intraday lines or working capital financing lines? We've seen a significant take-up across the board. You think about our instant payments book of work, our cross-border volumes. We're seeing double-digit growth in cross-border volumes. We've seen a significant double-digit growth in instant payments around the world. Those payments arrive within seconds. So we've built out a new platform called Citi Payments Express. We've built out a new trade platform called Nirvana, which allows suppliers to be onboarded much, much faster. It's in the name.
It's a great name.
You wouldn't think it would be a payment system, but carry on.
But what it does is it allows suppliers, as companies change, it allows us to onboard suppliers. Previously, it would take a couple of months to onboard a supplier. Now we can do it in less than a week.
Can I ask you this question?
Sure.
Something to give some thought to. If I was going to start a new company today, the answer to where I'm going to start it, is it changed? The answer from 10 years ago versus now, is the answer different?
I would say yes, because I would say if you step back and think about that, you would say the world's gone far more digital. You can be sitting in Kansas and you could be sitting running a global operation, because if you think about marketplaces and how they operate, you could actually set up a company and have clients across the globe. You could have a supply chain across the globe. You could run it pretty much from anywhere in the world. And I think technology today is very different to the technology from 5 or 10 years ago, with instant payment platforms having been built out, with us having invested in trade finance as well. But most importantly, I would say the next 5 to 10 years looks even more exciting, because with blockchain coming online, along with AI, as you think about smart contracts and the ability to inject that into an e-commerce, either an e-commerce platform or into your supply chain, that is going to be a key driver for how we see commerce and activity picking up across the globe.
Real quick here, are you seeing supply chains move away from the Middle East yet? Have you seen any material shift directly tied to the Middle East region?
I would say it's too short a time period for us to say that, we're seeing any movement away from the Middle East. I would still say Middle East is obviously one of the largest, as a region, one of the largest producers of oil, of course, across the globe. I would also say, given our presence in the Middle East and what we see and hear from clients, all of those clients are driving their agendas around the globe as we speak. We're actually helping them immunize their business from some of these, what I would call short-term shocks. But I actually expect to see significant growth in the Middle East. We continue to invest in that region. We continue to see potential beyond what we're seeing in the very short term.
Shahmir, appreciate your time. Thank you,
so
sir.
much.
Thanks for breaking it down. Really interesting stuff. Shahmir Khaliq there of Citi on the supply chain shift we've seen, not just over the last few months, but the last decade or so. And these supply chains have faced shock after shock after shock ever since 2016.
Yeah, just in time going to just in case, and the extra cost that builds into the system as well. How does technology offset that? I think increasingly. I mean, I think about what some people at my house are doing with Claude. I mean, you just think about what you could do in terms of planning your supply chain. It would be a very different story.
Is that where all the Mac Minis are?
Yeah.
As a Bramo.
I mean, honestly, I don't even know what goes on in there.
Don't want to know either. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. The Pentagon is expanding its use of AI on classified networks, signing new deals with NVIDIA, Microsoft, Amazon Web Services, and Reflection AI. The effort comes as the Pentagon races for AI alternatives to Anthropic's Claude amid ongoing disagreements with the company. Elon Musk's total compensation for 2025 topping $150 billion, according to a regulatory filing. However, that pay is tied to stock and operational milestones that have not been met yet, meaning his realized compensation for the year was actually zero. And Wall Street executives and New York City's ultra-wealthy are uniting against Mayor Zohran Mamdani after he criticized a home owned by Citadel's Ken Griffin. Business leaders like Dan Loeb, Lloyd Blankfein, and Mike Novogratz criticizing the tone of the mayor's statement as he tries to add a tax on second homes in the city. That's your Bloomberg brief. John?
Yahara, thank you. Thank you very much. I don't like the framing. I don't want this to become a story of Mamdani, the socialist, versus the ultra-wealthy and a battle between the two. This should be about business leaders, wealth creators, employers in this city, and what they think we need to do to make sure that New York City stays an attractive destination for all of those things. If we reduce this in the media to a battle about wealth and the haves and the people who don't have, you're going to end up with a very different fight politically. This needs to be about what's good for the economy so that people actually want to come here, live here, have a job here, be employed here, and pay taxes here. Because right now, that's not the debate that I'm hearing play out.
When you look at the amount of revenue that we brought up from the pied-à-terre tax, it is negligible relative to the potential wealth you could lose. And this is what a lot of people are pointing to, and it should be the economic discussion of how you attract capital, because ultimately, this is a capitalist city, and it's run in, that's sort of the point,
You know what the media wants, right?
What does the media want?
Billionaires versus the socialists, they want that fight on the front page. The people who cover this story, look at how it's written.
Yeah, no, it's true. You're right, you're not wrong. You're not wrong. It makes a good story, but the reality is that dollars and cents make a city go.
Precisely. Up next on the programme, funding AI ambitions.
If they were to issue 30 billion, you'd hardly notice it. That's how big they are. That's how little leverage they've carried. These guys have the demand. They'll show you the demand. And I think these guys are right to borrow.
Up next, we'll catch up with Amanda Lynam of Goldman Sachs, live from New York City. You're watching Bloomberg TV. Equity futures this morning positive by 0.1% on the S&P 500. On the Nasdaq, slightly lowered. We're down by 0.15%. Meta yesterday hammered, down by almost 9%. Under surveillance this morning, funding AI ambitions.
If they were to issue 30 billion, you'd hardly notice it. That's how big they are. That's how little leverage they've carried. And in our conversations with a lot of big borrowers, we want to know, do they see the demand? These guys have the demand, they'll show you the demand, and they can't monetize it until they put in place the capacity. So there is a big build to go. And I think these guys are right to borrow and get that build going.
So here's the latest this morning. Meta selling $25 billion of investment-grade bonds after raising its capex guidance to fund its AI build-out. Amanda Lynam, the chief credit strategist at Goldman Sachs, writing, "We see scope for additional issuance, but not nearly as much as the hyperscaler balance sheet debt capacity suggests." Amanda joins us now for more. Amanda, good morning.
Good morning. Thank you for having me.
And congratulations on the new seat.
Thank you so much.
Which is kind of like the old seat, but it's good to see you back.
Thank you.
Welcome back to the studio. Let's talk about the issue we got yesterday from Meta. Some people have talked up demand fatigue for this debt coming from these particular players. What was your view of things?
Yeah, it's a great point. I wouldn't characterize it as fatigue for the issuers. What I think is it's investors very carefully navigating market saturation constraints. We've actually used the U.S. banks as a really good case study. The U.S. banks are the largest issuer in the U.S. IG market. None of them are more than 2.3% of the index, and none of them have more than $175 billion of index eligible debt. So when you think about what Bob mentioned, he's absolutely right. Their balance sheets are so low leveraged that they have capacity to add a significant amount of debt. The point we're making is not all of that will happen in the traditional U.S. IG market because investors will need to manage those issuer concentration constraints. So what does that mean? We've already seen issuers issue in euro, Swiss francs, sterling. Actually, if you look at the euro AA market, more than half of them are U.S. companies, and 2 of the hyperscalers are in the top 5. We've seen private infrastructure, private real estate, and we wrote last night a deep dive on kind of this new structure that's being used, these JV type deals that are kind of off index, off balance sheet, very different. We've emphasized the importance of construction risk coverage and claim to tenant. But this is a paradigm shift for the corporate debt markets because there's a significant amount of financing such that none of these markets in isolation will be able to handle it on their own. So it will need participation.
It's also happening very quickly.
Yes.
That's the big change as well, that a number of years ago, these companies weren't doing any of this.
Right.
And now a few years later, they're doing tons of it. Right. You talked about maybe falling short of capacity. What kind of size are you expecting in issuance just from these big names?
So we've seen $400 billion in total of AI-related issuance, not just hyperscalers, but across IG and high yield, most of it in IG, since mid-2025. Our equity analysts are expecting $4.5 trillion of spending from the 4 large hyperscalers from 2025 to 2030. If you drill that down just to this year, that puts CapEx spending around $700 to $725 billion. That was actually the estimate coming into earnings. When you think about the capacity that these companies could issue, again, we would go back to those kind of market saturation limits, the case study of the U.S. banks. There's a significant amount of debt capacity on paper that these companies have, but do they use all of that in the U.S. IG market in 2026? We don't think so. This reminds me very much of some of the structural shifts that we saw earlier, even in the 2010 period when pharmaceuticals did a lot of debt-funded M&A. They issued debt into the market. This is obviously a much, much larger scale. But I think what it shows you is that these companies are using their balance sheet capacity thoughtfully, strategically, not all at once, and they'll be tapping a variety of different markets. We already have an above consensus forecast for U.S. IG issuance of $2.1 trillion. That would be a new record. And it's pretty clear based on this development that the risks are skewed to the upside.
Companies might be smart about how they issue, and definitely investors are being smart about concentration risks. But what about holistically? Concentration risk tied to AI injected into the investment grade bond market. Does it make it inherently more concentrated and frankly riskier as a result?
So U.S. banks are still the dominant sector, anywhere between 20 and 30%, depending on how wide your financials net is in your classification. I think there's plenty of room to go before that happens. I think really this is a longer term trend that we think has momentum. These tweaks around the margins on CapEx spending aren't enough to move the needle on how they will approach the financing, at least through the medium term. And again, as was cited earlier, these companies have such incredible balance sheet capacity that they can almost afford to kind of overspend in some areas. As we get, 4 or 5 years from now, I think there will be a more nuanced discussion about were the early investors the winners? How are we thinking about that? I would say our software analysts are already kind of digging into that. We stay in very close touch with them, but I don't think it's shifting the risk. I think what it is doing though is it's changing the makeup of the market such that actually some of this debt is occurring outside of the index, and so it's causing investors to be a little bit more creative about where they're looking.
Are you seeing any reluctance by investors to invest in lower grade debt, particularly tied to some of these issues, not necessarily the hyperscalers, but given the fact that private credit seems to have retrenched a bit too?
Well, I think private credit, is an interesting use case because there's a lot of noise around retail redemptions. But if you look at retail vehicles as a percentage of the market, it's actually only 15%, and those institutional vehicles don't have the drawdown. So I think if anything, if there's a disruption, private credit probably deploys on the back of that, especially from the institutional community, because there's a lot of dry powder. To answer your question, no, we're not seeing people shy away from risk. And in fact, within the IG market, we actually prefer the BBB pocket of the market, because if you take a step back and you say, where is there the scope for the most balance sheet deterioration? It's actually at the high end of the rating spectrum. So that's a view that we have. And I think a lot of investors kind of recognize that as well. They're just positioning, they're not taking it as a spot credit fundamental metric. They're saying, okay, what is the go forward and what is the supply?
Is there concentration in tech at the high end of the rating spectrum? Are they the companies you're thinking about?
It is. They're mainly AA or AAA. Again, very similar to what happened in pharma. I mean, at one point when I was covering pharma, some of these companies were AAA rated, right? And they did debt-funded M&A and they slowly moved down. That's fine. There's still great credit risks. It's just baking that into your forward expectation is important.
Incentivized by the market to issue more debt, ultimately.
I mean, right now people can't get enough, and they are being careful about how they do that. I love what Amanda said about how that's the reason why they're going to Europe, not because they think that necessarily can finance better or that they want euros, but ultimately they need to be respectful of some of these constraints in the index.
Amanda, it's good to see you. Welcome back.
Thank you so much.
Amanda Lynam, back at Goldman Sachs. It's good to see. Breaking down the credit market and the issuance we saw earlier this week from Meta.
Yeah, and people saying that, they only got $96 billion of offers to buy their $25 billion offering. It was $125 to $30 billion. Oh, your
96,
lord.
96, small violins and all that, yeah? All right. Up next, Yoder of JPMorgan Private Bank, Dan Ives of Wedbush, Alejandro Grindal of Ned Davis Research, and the NASA Administrator, Jared Isaacman. All of that in the third hour of Bloomberg Surveillance.
If there's a war, nobody told earnings.
What's really driving the market higher has been extremely strong earnings.
If you look at the earnings we've gotten, they've been incredible.
The earnings story is overpowering.
As far as kind of the main driver here, it will continue to be AI.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Following a 10% gain on the S&P 500 last month, we look to add to it this month, up 0.2% on the S&P 500, down 0.1% on the Nasdaq 100, which is nothing compared to the 16% advance we saw through the month of April, the biggest monthly gain since 2002. In a bond market, we're shaping up as follows for fixed income. 2s, 10s, 30s, yields higher by a single basis point on the 2-year at 388, 10s at 438, dragged higher by elevated crude prices. Brent crude 111, WTI 104 so far this morning.
We heard a bit of a hawkish tone over in Europe in particular. We seem to be expecting now a June rate hike from the European Central Bank. A question about whether the U.S. Federal Reserve will actually shift to more of a neutral stance when it comes to symmetric risk. Is the next move going to be a hike or a cut? There has been a sea change, though, given that now we're looking at higher for longer, and people are gaming this out and saying that the resilience in the U.S. economy will allow the second-order inflationary effects to remain stickier.
Pricing in this market was super hawkish, and I think we fell just short of that, the ECB and the Bank of England earlier this week. But still, on their own, they were quite hawkish decisions. Bank of England is considering rate hikes. I don't think they're there yet, but they're considering it. The ECB, to your point, is getting super close. June's very much on the table. For the Federal Reserve, we're talking about removing the easing bias, articulating a more symmetrical reaction function over at the Federal Reserve. And for BNP Paribas, it's not the consensus view, but for BNP Paribas, they believe there is a risk of a rate hike this year. And it depends on two things. One, you have a continued closure of the Strait of Hormuz and energy prices remain elevated. And two, unemployment declines, which puts a lot of weight on next week's labour market report. Does this labour market support higher prices? That's the question we keep going back to over the last 2 months. Next week, the payrolls report, the estimate's 60k. The range is super wide, the low 0, the high is 140. The unemployment rate's key, 4.3% at the moment. If you start to see that drift lower, because we actually are seeing an underlying pickup in the US economy, the conversation around broad-based inflation pressure is going to change pretty quickly.
Especially when you put it together with the lowest jobless claims figure going back to 1969, with an ECI figure that crept up the employment cost index in yesterday's GDP report, signaling a little bit of strengthening there. And what we heard from Neela Richardson of ADP saying she's actually starting to see recoveries in the underlying labor market. You put all these things together, that was what allowed inflation to take hold in 2022. Is that a bit more of a factor than some people had expected in 2026?
I'm not talking about 8, 9, 10% inflation, of course, but something closer to 4 to 5 versus, say, 2 to 3. Conversation shifts quickly.
The issue that a lot of people have in this market is they believe that Kevin Warsh is going to be dovish, period, full stop. He is not going to hike rates because ultimately he has an obligation to at least keep rates here, given some of the, not an obligation, but he clearly has a desire to do that. So the question is, how do they control the yield curve, considering that you might get a different reaction in the long end?
Want to keep digging? No. Let's get to the weekend. Coming up this hour, Yoder of JPMorgan Private Bank with stocks entering May at record highs. Dan Ives of Wedbush recapping a busy week for big tech. And Alejandro Grindal of Ned Davis Research saying there's still a chance of a rate cut this year. We begin this hour on the Federal Reserve. Bloomberg's Mike McKee has some headlines for us. Good morning, Mike.
Good morning, John. Well, Lisa was talking about the dissenters and what they might do down the road. It has become a tradition for dissenters to put out statements, and we have a couple of them this morning from 3 members of the Open Market Committee who voted against the Fed's decision because of what they say is an easing bias they don't support. What is that easing bias? Had a lot of questions about that after the Fed meeting, and this is the phrase they don't like. In considering the extent and timing of additional adjustments to the target range for the federal funds rate. That, according to Neil Kashkari, is the wrong thing to say at this point. He sees 2 scenarios ahead, neither one particularly great for the Fed. One is a fairly quick reopening of the strait, which means rates will be on hold for an extended period, or an extended closure, which would mean rate hikes and potentially a series of them. In his statement out this morning, fairly long one, he says, given the uncertainty about the path of the conflict and the resulting effects on inflation, employment, and economic growth, I believe the FOMC should offer a policy outlook that signals the next rate change could be either a cut or a hike. This could tighten financial conditions somewhat today, pushing back against a high inflation scenario that could require an even stronger monetary policy response in the future. We are also getting a comment from Beth Hammack, who voted against the Fed decision as well. The Cleveland Fed president saying, this forward guidance was put into the statement to signal a pause rather than an end to the easing cycle. I see this clear easing bias as no longer appropriate given the outlook. Inflation pressures continue to be broad-based, and rising oil prices present an additional source of inflationary pressure. Uncertainty around the economic outlook is elevated, with upside risks to inflation and downside risks to growth and employment. Lori Logan of Dallas is the 3rd person to vote against the statement because of the easing bias. So far, we have not heard from her, but if we get a statement, we will bring that to you as soon as we can.
Mike McKee, thank you, sir. Appreciate the breakdown. Thank you very much. The easing bias is no longer appropriate. The Cleveland Fed president this morning, echoed by the Minneapolis Fed president as well.
With this idea that potentially having this sort of more symmetric reaction function could tighten financial conditions enough to not have to make them hike rates. So this is sort of some mental jiu-jitsu for markets. Can we get our desired goal without having to inflict higher borrowing costs?
Slightly more hawkish Federal Reserve this week. Crude prices still elevated, yet we enter May at all-time highs on the S&P 500, kicking off a fresh trading month. Yoder of JPMorgan Private Bank writing, despite no end to the conflict in Iran in sight, earnings didn't blink. Companies are beating expectations at a pace we haven't seen in years. Abby joins us now for more. Abby, good morning.
Good morning.
Does this mean the situation in the Middle East doesn't matter, or just doesn't matter yet?
I think it doesn't matter yet, right? Like, you're not going to really, we tried to lay out 3 scenarios when this conflict originated, thinking about, what would it take for it to matter, right? And there is a period of time, like a length that is a duration that is important to keep in mind. And for us, that's 3 to 6 months at these elevated prices, particularly north of $100 or $120 on oil. And so that's really where we're more concerned if we continue to see this extended through the summer, particularly given, the heavy driving season. And you've already seen that percent of disposable income for the median consumer go up from around 3.5% to 4% on gasoline. So if that continues to move higher, then that could weigh on economic growth and sentiment more broadly. I think the sentiment channel is very important.
Started to see it in sentiment already.
Yes.
Consumer sentiment is really depressed.
Has been the case for the past 4 or 5 years.
Well, this is
difficult.
the question.
It's very
the question I was going to ask you. Why is that relevant? Because it hasn't been.
Well, it's relevant because, it's stark in the sense that it's the lowest it's ever been, and it's at odds with what's going on from an economic standpoint and from a stock market standpoint, earnings standpoint. Because at the end of the day, what ends up happening is we look at all these confidence measures, we want to have some read through there, but then when you look at the spending figures, right, the banks all reported in the first couple of weeks of earnings, and nominal and spending growth is really solid. Like, a lot of these CEOs were like, you know what, you can't ask us this anymore, because at the end of the day, like, consumers are still spending, whether they feel poorly or not, they continue to spend. And the makeup of that spend, I think, has shifted, right? It's much more services oriented in our view, but it's still very elevated relative to history.
Has there been a shift over the past couple of weeks? And I ask this because Mark Zuckerberg, in this letter that he sent out at Meta, said that there was a trajectory change in Meta's ad business after the start of the U.S. war, saying if oil prices go up, then consumers spend more of their money on oil, on gas, and less on things that they would just buy that are just kind of discretionary things that the advertising might serve. Do you see this in any kind of way, or is this an excuse?
Well, you haven't seen it in the results in terms of ad spend growth and the actual usage of these apps in terms of what they're spending on. I think what we're worried about, again, is if this stays higher for longer and it creeps more into the confidence levels of consumers, that you start to see that spend shift. But for the most part, we just really haven't seen it in terms of the ad spend and the growth from a lot of these mega cap names.
What's the argument to go more into equities right now after the rally that we've seen, as oil prices continue to go higher and as yields continue to rise? Why not just cash out and kind of have a more conservative portfolio and just sort of sit tight and wait for the next leg?
Well, so first, if inflation is in fact going higher, then you are losing purchasing power from anything that's like short-term cash-related investments. I think the other thing to keep in mind is we're at all-time highs in an equity market, but the valuation is actually lower than when we started the year. And that's because we've seen earnings revisions that are in excess of what we've seen from a price reaction standpoint. So, for example, for 1Q earnings, we started this quarter with the expectation that earnings would grow 12%. Now, with a little bit over 50% of market cap having reported, we're at close to 20%. That is enormous. And that's the 6th consecutive quarter of double-digit earnings growth, right? So if you think about it, these aren't easy comps, right? We're already growing off of a very high base. And I think, obviously, technology and the tech-related sectors are what's driving that. And the margin profile of the S&P 500 is just very different than it used to be, 10, 15 years ago. So when you're looking at, the elevated PE of 21 to 22 times, but the makeup of this is just very different and is worthy of that higher multiple.
Can we finish on one of your sector favourites, something you know tons about, chips?
Yeah.
The rally we saw in semis, 40% move in April. What do you tell people they should do in that sector now after a rally like that?
It's buying on strength. I think when you really, I think this is part of the hard, reconciling this. Like, we're 3.5 years into when, this AI cycle. And I don't think that anyone would have thought that 3.5 years in, the infrastructure players would have been still the beneficiaries of this trade, right? You would have thought it would be the adopters, and you're seeing all of these, the margin expansion story happen and play out. But because we're so supply constrained, and energy constrained, it really is that you're still seeing these the nuts and bolts of this build out. Those are still the winners, and we don't foresee that changing in the next 2-3 years. Really.
I'm tracking the industry for so long, though. That's why it's often so cyclical. That initially it's supply constrained, they build it out, the opposite happens, bust.
Particularly on the memory side, right?
So why is this different? Why does this have a longer timeline?
Well, because I think when you think about the starting line, we just didn't have the industrial capacity to really build out what we need now, right? This all happened and accelerated very quickly, and we just didn't have the industrial base. Now there's obviously a lot of incentives to build that out, but we're still very far behind. And I think it's really been over the last 8 to 10 months, call it, where you've also seen it's just been this trade around all of these different components that go into this, right? Whether it's optical, whether it's memory, where those weren't really, at first it was just GPUs and it was just, the compute, but now it's just this broader set of inputs that are all needed that we don't have enough of.
And you think people should stick with that trade?
Yes. Within tech, we're, semis over hardware over software.
Okay. Abby, appreciate it. It's good to see you. Thanks for breaking it down.
Thank
Abby Yoder there of JPMorgan Private Bank. The equity market coming into May at all-time highs, looking to add some weight to it. The S&P higher by 0.2%. With an update on stories worldwide with your Bloomberg brief, Yahira has more. Hey, Yahira.
Hi, John. We are seeing both Chevron and Exxon shares rising in the pre-market, both oil majors exceeding profit expectations as higher oil and natural gas prices outweighed production outages from the war in Iran. Exxon is sticking with aggressive buybacks, while Chevron's smaller repurchase pace is disappointing some investors. OpenAI CFO Sarah Friar pushing back on concerns about missing internal targets after that Wall Street Journal report. Friar saying the company is meeting objectives and that OpenAI is seeing a, quote, vertical wall of demand for its products. And President Donald Trump says he doesn't care if Fed Chair Jay Powell stays on as a governor after his tenure as chair ends. The president saying he just wants to make sure Kevin Warsh gets confirmed as the next head of the Federal Reserve. That's your Bloomberg brief. John?
Just turning down the heat just a little bit over at the White House with regards to the Federal Reserve.
Honestly,
story of the week, no?
I saw that and I was just like, who dis? I mean, honestly.
They don't want the fight.
Okay, but this, to me, they don't want the fight because they're taking the high road? Well, or is there some other reason? Are they just waiting for Kevin Warsh to get in and then they're going to go harder? I don't really understand.
I can only sort of observe what's happening right now. I can't predict a thing. The president can change, of course. He can change his mind and write a social media post in about 2 minutes' time saying completely the opposite. But the trend so far seems to be turn down the temperature just a little bit.
There's a peace pipeline being built between the Fed and the administration.
We've got something from Axios once again, so here we go. It's bullish. Iran delivered on Thursday to the US through the Pakistani mediators its response to the latest US amendments on the agreement to end the war, according to a regional source. That crossing just now from Axios. As those headlines cross, futures at session highs on the equity market, up by a third of 1% on the S&P.
Yeah, I immediately go to crude to see exactly what kind of reaction there is. And you do see a little bit of a decline. You see almost now a 2% decline on WTI. That said, how much can people put credence in this and how long will that move last, given the fact that we've been subjected to this headline roulette for quite a while and people have learned that it can be a time to lose money?
And the president appears to be committed to the naval blockade at the moment. We'll get some more headlines for you in just a moment. We'll break that down in about 2 minutes' time. Up next on the programme, the morning's calls, plus Dan Ives of Wedbush recapping a busy week for big tech. That conversation up next. Equity futures near session highs, up by 0.3% on the S&P 500. This from Axios just moments ago. Iran delivering on Thursday to the US through the Pakistani mediators its response to the latest US amendments on the agreement to end the war, according to a regional source. Things just picking up just a bit.
Yeah, although what we have seen is an initial knee-jerk reaction in markets when you take a look at crude and then that reset, because people were looking at what this means and there isn't necessarily a clear sense, at least in crude, in Brent crude. In WTI, that's holding. So, maybe people are just optimistic this morning. Maybe it's just an issue of people wanting to move on.
Look, the negotiations happening in real time. The president said yesterday only a few people know what's going on with the talks, and he clearly knew something that we didn't and didn't want to share it. The one constant, and I'm always thinking about the one constant and what are people comfortable with, the one constant is the naval blockade. And based on the comments we've heard from administration officials just this week, they seem pretty comfortable with maintaining that blockade.
That said, most people seem to think that there's some sort of deadline because of the economic damage being done, whether it's the midterm elections for President Trump, whether it's political unrest for the Iranian leadership amid hyperinflation and an economy that's really struggling. That's what's giving people hope that there will be a near-term end. It's a near-term shock. It's not a long-term reality that's going to increase the price of crude.
Things can change really quickly. So that's the latest reporting, and we'll see if we hear from the president going into the opening balance. We often do sometimes. Equity futures close to session highs, up by 0.25% on the S&P. Crude declining. Brent down by 0.2. WTI down by a little more than 2%. That's the price action. Let's get you some morning calls. One stock in focus, Apple. Barclays raising its price target while remaining underweight, viewing third quarter revenue guidance as, quote, very strong. Elsewhere, Wells Fargo raising its target to 310, expecting focus to remain on the management of memory and storage inflation into the second half of this year. And finally, Morgan Stanley boosting its price target and staying overweight, calling Apple a, quote, thematic mega-cap winner. Bloomberg's Ed Ludlow joins us now for more. Ed, are they the winner overnight?
Yeah, but it was an in-the-moment change of fortunes, all on the guidance. Third quarter or June quarter revenue to grow 14% to 17% in an environment where Apple is very clear that demand is greater than their ability to supply. Chips are the constraint, particularly impacting iPhone and Mac. Memory costs are rising. They've managed it. The margin numbers were very strong. And, you know, Tim Cook held his cards close to his chest on how that rising memory environment is going to be managed by Apple. They are the master of pulling the levers, John, aren't they? So we didn't learn as much as perhaps we wanted, but it was amazing to see how quickly the sentiment of markets changed towards Apple. And then China, a standout. You know, really growing beyond expectations. The surprise was that incoming CEO John Ternus briefly appeared on the call and said, there's a great product roadmap ahead. I'm not going to tell you anything about it. But it was a kind of interesting moment for the market, too, because either he was going to show up or he wasn't.
Just a warm-up act for later this year. I think we're going to hear more from him, no doubt. Ed, thank you, sir. Looking forward to the programme. Bloomberg Technology, about 3 hours away on Bloomberg TV. Dan Ives of Wedbush maintaining an outperform rating and a 350 price target on Apple, writing, it's all about the AI strategy. Dan joins us now for more. Dan, welcome to the programme. Tell me more. What is the AI strategy at Apple?
Look, I think that's what we're going to find out at WWDC, but I think with Gemini as a partner, it's going to really start what's going to be a subscription service when it comes to the AI strategy for Apple. The consumer AI revolution is going to go through Cupertino. We think this could ultimately be an incremental 10, 15 billion per year of services. They're firing on all cylinders right now. In terms of iPhone growth, services, Ternus obviously taking the baton. A lot of focus on WWDC. I think it's going to be a golden age for Apple as they finally monetize the consumer AI revolution.
What's going to be a positive use of CapEx, Dan, given the fact that we did see a big increase in R&D and this pledge to potentially have the optionality to use their cash for some sort of investment in the future?
Yeah, look, in terms of investments, like, you know, they've almost been light on CapEx. And you could say that's actually been a positive for them. I continue to think with Ternus at the helm, they're going to be more acquisitive. That's another thing that's important. It's been missing as part of that DNA in Cupertino. When you look at the AI strategy and you look at the install base, they have things that no other company has. 2.5 billion iOS devices, 1.5 billion iPhones. Now it's about ultimately from acquisitions to starting to build out CapEx, partners, and will ultimately be an AI-enabled iPhone as we go into 2027.
Dan, is it a problem that all of the tech players are paying more for less? Essentially, they have to pay more money for all the components that are getting more expensive, that potentially will get more commoditized down the road, but they're in an existential race to keep up?
Yeah, look, it's an arms race, and these companies cannot all of a sudden take foot off the gas, because otherwise they'll be on the outside looking in. I mean, I saw it in Asia, being there, you know, for the last few weeks. You see demand to supplies 10 to 1 for chips. So it's what they need to do in terms of GPUs, in terms of capacity. Now, Apple, they're in a different position because it's on the consumer side. And obviously for Apple, they have the install base. But when it comes to CapEx, you look at big tech this week, this is about as bullish as you could have gotten in terms of news of big tech.
Well, Dan, with the exception of one story, and it's the doubts around OpenAI. So can we finish on that? What's your read, your understanding of what's happening inside that company at the moment?
Look, I mean, if you look at Anthropic, it's been a historic run that they've had, going from 9 billion run rate to 30 billion. I think that definitely caught many by surprise. And I think at OpenAI, they were top of the mountain. They got bullseye in the back. And now they have to really focus on the enterprise. But in my opinion, they will be one of the core stalwarts over the coming years. It's not just going to be about Anthropic. They're just going through some perceived speed bumps. But I think now they'll navigate. And I think getting this trial over will be important, too, in terms of the soap opera between Musk and Altman.
What do you call that game, Bramo? Tic-tac-toe?
I guess so.
In the UK, we call it noughts and crosses.
Yeah, it's tic-tac-toe.
Is that what that is?
Well, I don't know. I think we need to do a special segment. Where in the world is Dan Ives?
Dan, is that what you're wearing? Is that tic-tac-toe?
It's tic-tac-toe. It's a bullish tic-tac-toe.
All right, thought so. Dan, thank you. Dan Ives there of Wedbush Securities, distracted by the new outfit.
Yeah.
Do you not notice the get-up?
I've always noticed the get-up. I mean, it's probably his own personal brand, right? Doesn't he have his own brand that he designs himself?
Yes, he does.
Well, no, I was distracted by the headlines because I was
actual
seeing,
news?
Yeah, I was
Please
actually.
share it.
I'm so sorry. I was actually reading the news. I apologize, but we are getting from the state-run Iranian media that they did give Pakistan its latest proposal for U.S. talks, and that the text of the proposal was delivered Thursday. So some real meat behind this, saying at least potentially talks are on the table. Both sides in the room is a positive for a lot of people in the market.
The talks continue.
Yeah.
The diplomatic effort moves on, and let's see if they make some actual progress here.
Yeah, I was also distracted by this headline. The call with Exxon is going on. Darren Woods, the CEO there, saying it will take 1 to 2 months for flows to reestablish after the Strait reopens. So we're trying to kind of game out a time frame here. Even if the talks are successful, how long would it take for A, flows through the Strait of Hormuz to restart, and B, how long would it take for the oil prices to really come down as a result of supply picking up? All of these things are going to be gamed out. The physical world versus the paper world, really, in contrast.
Just a bit of pushback against the potential for an export ban as well. Exxon saying this, that export bans and price caps will result in less supply. The latest from Exxon so far this morning. Up next, we'll catch up with Alejandro Grindal of Ned Davis Research, saying there's still a chance for a rate cut later this year. The opening bell about 60 minutes away. Equities looking to add some pretty stellar gains through the month of April. Welcome to May. Equity futures up by a third of 1% on the S&P. On the Nasdaq, up by a tenth of 1%. On the Russell, higher by 0.2. In the commodity market, pulling back, down by 2% on WTI. Brent crude just a little bit softer as well. Some movement in this market, supportive of risk appetite in the last 10-15 minutes. Let's get you an update on the latest in the Middle East. Tyler Kendall joins us from Washington with more. Hey, Tyler.
Hey, John, good morning. Well, some potential progress here as Iranian state media confirms that the country has sent an updated proposal to the U.S. through Pakistani mediators. Now, we don't have information on exactly what changes were made, but it is our understanding that earlier this week, the plan that Iran had put on the table was deemed unacceptable by the U.S. As you well know, Iran has floated the idea that we could see a reopening of the Strait of Hormuz in exchange for the U.S. lifting its naval blockade. Iran also wanted some other concessions, according to Iranian state media, including assurances that the U.S. won't attack again, compensation for damages, and a legal framework for the Strait of Hormuz, many of which are considered to be non-starters for U.S. negotiators. But perhaps the biggest lingering non-starter that was put out there earlier this week was that Iran wanted to see dialogue postponed when it came to its nuclear program. So we'll be watching to see if maybe there's been any sort of progress in that regard, considering the White House made it pretty clear that they don't want to agree to a deal without some sort of curbs being put forward when it comes to Iran's nuclear capabilities. Because, John, as you well know, at this point, this White House is maintaining that that naval blockade is not going anywhere. Just yesterday, President Trump called it, quote, incredible, and said that the U.S. maintains that it will continue to squeeze Iranian oil exports.
Tyler Kendall with the latest. Tyler, thank you. Appreciate the update. A story to watch as we approach the opening bell to see what kind of response we get from the U.S. side. Not sure what time the president received that particular proposal either from the Iranians.
Yeah, and whether he has signed off or whether he wants talks to continue. At what point do they think they have sufficient leverage to really go into a discussion, especially considering the both sides view each other as unreliable, and a lot of negotiators have complained about this issue.
Let's turn to the U.S. economy. The data so far this week has been pretty decent. Next week, we'll get payrolls data. This week, the Federal Reserve coming this close to dropping its easing bias. With the latest, Mike McKee is back with us for more. Good morning, Mike.
Good morning, John. Not close enough, according to those Fed officials who voted against this week's decision. We brought you that at 8 o'clock. We will see if we get any more dissenters out there or people talking in the weeks ahead. But this week did move us forward a little bit because Kevin Warsh's hearing was held, and the Senate Banking Committee voted to advance his nomination to the floor. Now it's just a question of when they can get floor time. They're off next week, so it may be the week after. The Fed stayed on hold, as you were talking about. In terms of the economy, we got a little stronger GDP than we did in the fourth quarter, led by AI business spending. If that keeps up, it keeps the economy afloat. Consumer spending falling back a little bit, and inflation at 4-year highs, especially gasoline prices. Is that going to cut consumer spending even more? We'll get some ideas next week. We have a lot of data. It's the first week of the month, and that's when we get jobs. That's the number one story, and that'll be Friday. But we also get ADP on Wednesday, JOLTS on Tuesday. So some jobs numbers scattered throughout the week. ISM Manufacturing's coming up at 10 o'clock this morning, but ISM Services next week. We'll see what the employment sections and prices sections of those reports are. Then we turn to the Fed. They are back next week. The blackout period is over, and we've heard, as I said, from Neil Kashkari and Beth Hammack this morning. Next week we get a lot of them. John Williams on Monday, and we get Mickey Bowman and Michael Barr Tuesday, Musallam Goolsbee Wednesday, Hammack, John Williams again on Thursday, and then Friday out at the Hoover Institution's annual conference, Chris Waller, Mickey Bowman, Mary Daly, and Austin Goolsbee, and we will be out there to bring you all the news from that conference.
Looking forward to your coverage, Mike. Looking forward to it. Thank you, buddy. As always, great work this week. When Mike was speaking, I was sitting here thinking, was that hearing really this week with Kevin Warsh? Is that earlier this week on Tuesday? It was like a lifetime ago.
I don't think we can characterize these weeks as weeks. I think each week can be its own year, and we should really treat it as such, considering the news. But you're right. It's a very fast-moving timeline, and it's a very fast-moving cycle. And I wonder what those speeches are going to be like of Fed officials, given the fact that the Kevin Warsh influence is looming very large, paired with the influence of a Governor Powell, who potentially could be on that committee, taking a super low profile, but has the potential to be a dissenter.
I've joked all this year so far that the week has felt one long trading day that starts on Sunday evening and ends on Friday, and you get one day off. It's Saturday. Just one exceptionally long trading day. In fact, the month's felt the same way as well, hasn't it?
It's been a wild ride, and everyone who walks into this studio has said, what an exhausting week, what an exhausting year. The nonstop barrage of information and having to respond to it, and frankly, the changing market structure in response to all of this has been mind-numbing.
If we can we bring up that calendar again of all the Fed speak next week? Now the quiet period is finished. There's tons of it. I'm just going to pick out one. The one guy I'm looking forward to hearing from. Not that I don't like everyone else on the board, but just the one person, Governor Waller. I want to hear from the people that aren't married to a particular policy. I want to cut rates. I don't want to cut rates. And it doesn't matter what happens. I want to cut rates. I don't want to cut rates. I want to hear from Governor Waller because his views seem to have changed recently about this economy. He was very close to voting for a rate cut not so long ago because of what was happening with the labour market. Something changed. And we know what that something is. It's the Middle East. How comfortable is he with current policy, with the easing bias? Is that changing for him as well?
Does he reflect what we heard from Neil Dutta and from others who also seem to be shifting toward a Fed that should not be cutting rates? Does he have a similar kind of feeling? Maybe not a rate hike, but this idea that maybe the easing bias needs to go away. Also, he might have really good tips on weightlifting because I've heard he is quite the heavyweight.
The deadlift.
I mean,
he can lift a lot of weight. I think, is it 370 pounds or something like that?
And he posted it on his social media post.
On
so
LinkedIn.
If you want to take a look, it is out there for a while.
Happy birthday to Governor Waller, by the way, whose birthday was earlier this week. Alejandra Grindal of Ned Davis Research writing, we expect the Fed to stay on hold in the near term, but there still is a chance for a rate cut later in 2026. Alejandra joins us now for more. Alejandra, welcome to the programme. What has to happen to get that rate cut?
Well, thank you for having me again. So a lot of, I would say perfect things have to happen. As I said, neutral is where we are at this point in time. No change. The economy, it's, hanging in there, not booming, but hanging in there. Labor market is reasonably balanced. Long-term inflation expectations appear to be anchored. So just sort of that wait and see mode makes sense. But yeah, that there is actually a potential pocket for a rate cut maybe in Q4, so later in the year. So a few things have to happen. One is one that I don't think any of us have a solution to, but it's the war needs to end relatively soon. In other words, we can't have these high oil prices for a long period of time, these supply chain disruptions, because it can have knock-on effects and sort of start getting into core prices. So that's one thing, and we don't have a clear answer on that. The other thing is we need to see that long-term inflation expectations do remain anchored. They are so far, so that needs to maintain in place. Remember, also, most of us were looking for, before the war, for inflation to ease in the second half of the year, partly because of the base effect from tariffs. So we should be able to see some of that. And then that's from the inflation story. But from the labor market story, this is something we'll be watching pretty closely. Right now, labor market looks pretty good. We expect just sort of a normal payrolls gain to be around 50,000. That's kind of the new normal, the Goldilocks we talked about last time. But come summer, there's a possibility that we have a lot of grads coming out of university, whether it's undergrad or graduate school. And with some of the uncertainty associated with the war, also AI perhaps taking over some of these entry-level jobs, we could see quite a few months of labor market softness. So I don't think 1 month will make the change, but if you see quite a bit of it, and all those other factors from the inflation story kick in, there is a path for rate cutting, I would say, toward the end of the year. But again, not guaranteed.
Well, that's the path. What's the likelihood? And that's the more important question. Is it just as likely we could see a rate hike? Because some people on the Fed want to communicate that.
So I think it's more likely to see a cut than a hike. And with the hike to happen, again, it's all predicated on the war, right? So if the war lasts for a long period of time and we start seeing those long-term inflation expectations, particularly the market-based ones, I think have done a good job. If those really start breaking out, then I think, hike, and again, the economy kind of holds in there. I think the hike would potentially happen. But kind of the scenario that I laid out, maybe I'm optimistic about the war maybe ending somewhat on the sooner side, then I think the cut's the more likely scenario.
Alejandro, there's a tension, and it keeps emerging as we talk with people on Wall Street who discuss the incredible earnings by corporate America, the incredible resilience, the incredible growth in the prospects for profitability, at the same time that people talk about the lackluster growth in the underlying economy and the labor market. At what point do you listen to the corporates as a guide for what's going to happen to the economy? And at what point are these things on two tracks, or even companies profiting at the behest of the labor market, at the behest of some of the profits by employees?
Well, I mean, I think this is a lot of the trend that we've been seeing even last year, is where you have companies doing well, they're spending a lot, maybe not hiring as much, but not firing either. And then the knock-on effect on equity markets is boosting that wealth effect, and you have that high-end consumer. I think that's been a constant theme, sort of supporting the economy. I think it just argues for a continuation of that K-shape that we talked about before, and even more so now with these affordability concerns. Ultimately, this means that this is an economy, using a technical term, that has weak breadth. It's not necessarily a bad thing. I would say another period where we had a very long extended K-shaped recovery was actually the post-GFC pre-pandemic period. It lasted for a long period of time. But the problem is when you have an economy that's led by such weak breadth, if that indicator, in this case, it's CapEx and AI spend, if that breaks apart, then everything comes down with it. So it just makes it more vulnerable to downside risk if it's hanging its hat on that one area of growth.
How much are people entertaining the idea that the reverse happens, that suddenly a lot of companies that haven't hired for a long time start rehiring or hiring more people, and people are more productive and they start earning more, and you start to see the individuals who do get hired, and you start to see a much better than expected economic backdrop going forward at the same time that there's an inflationary shock? I mean, how high is the bar to potentially hike rates in a scenario like that?
Maybe not until, say, next year, but I love your optimism because we actually kind of went into the year viewing things that way. We expected actually a broadening of CapEx. Maybe some of the tariff uncertainty would subside a little bit. The OBA would help a little bit. The Fed, remember, was expected to ease for sure, and that would lower interest rates and allow investment spending to, go to a broader degree. So, there's still possibly a path toward that, but I don't think the Fed's going to move to hiking if inflation sort of ends up in a good position, because your argument was that you see an expansion and a rise in productivity. And if we see faster productivity growth, then, holding all else constant, we shouldn't have higher inflation pressures. And then we're just sort of, back to this ideal Goldilocks scenario.
Lisa, optimistic. Hey, what an accusation.
I just sent you a
Shocking.
message. I love your optimism. Words I'll never hear again.
Alejandra, thank you. Just for the record, she's taken a long weekend, taking Monday off. Alejandra Grindal there of Ned Davis Research.
Yeah, take my mom out for her birthday. Look.
I love that. Happy birthday, Mum.
Yes, thank you. I appreciate it. It's sometimes important to reset, amid all the crazy. But I will say, I want to be optimistic. I have some people at home telling me that they're long technology over humans. I see the flow of things. So, I'd like to see.
This is what people don't know. In the family, on a relative basis,
I'm the optimistic one.
You are the optimist.
100%. Although they are optimistic about technology, so that's great. But, negative on humans.
Let's get you an update on news elsewhere. Unreal. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Axios reporting that Iran has delivered its response to the latest U.S. proposal to end the war. Iran state media confirming it delivered the text of the response to Pakistani mediators. No details yet on the response have been made public. Novo Nordisk is rebranding its diabetes pill as Ozempic in the U.S., leaning on the brand recognition of its blockbuster drug. Novo will make the pills in the U.S. and sell them to patients through its direct-to-consumer platform and select telehealth providers. And in sports, the Minnesota Timberwolves are moving on to the second round of the NBA playoffs after beating the Denver Nuggets in 6 games. The Philadelphia 76ers are heading back to Boston for a decisive Game 7, and the New York Knicks eliminating the Atlanta Hawks after winning Game 6 by 51 points. That's your Bloomberg brief. John.
Yahara, thank you. Thank you very much. Up next, we'll catch up with the NASA administrator, Jared Isaacman, following a successful Artemis 2 mission. Plus, Yahara's back with your morning movers. Another check on Apple rising after earnings impressed. That stock is up by 3.6%.
We're seeing companies really basically stepping back and saying, how do I think about my supply chain? We're seeing a lot of the companies move from just-in-time to thinking about production resiliency. That, by definition, means you're going to run a far more expensive and a far more diversified supply chain and a far more resilient supply chain.
That was Shahmir Khaliq of Citi weighing in on the situation in the Middle East and the shift we've seen for global businesses to just-in-time, to something very, very different and slightly more costly.
Just in time to just in case, which costs more money and needs a different type of technology. You can't send your money over and wait 3 days for them to receive it if you're dealing with rapid fire supply chains that are shifting in real time.
Equity futures this morning shifting in real time, positive by 0.2% on the S&P 500, following the biggest monthly gain going back to 2020 on the S&P 500. On the Nasdaq 100, you've got to go back to 2002 for a gain as big or bigger than the 16% gain we got on the Nasdaq 100 just last month. This morning, down 0.1%. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Apple really blowing it out of the water as the last tech name to report. Shares are up 3.5% in the pre-market, but Apple making it clear that its results would have been even stronger if it weren't for those supply constraints around memory. But Bloomberg Intelligence points out that may be the reason it's making strides in China, since its competitors have had to raise prices due to those higher memory costs. And for that same reason, it is surprising to see these names down in the pre-market. SanDisk and Western Digital both falling, even after delivering a beat and a raise, but the bar was just too high, with SanDisk up 300% year to date, Western Digital up 130%. And we end on shares of Estee Lauder soaring 11.5% in the pre-market after the beauty giant raised its profit outlook, helped in part by job cuts, announcing another 3,000 today, bringing the total to up to 10,000. John.
Yahara, thank you. Thanks for this morning. President Donald Trump hosting the Artemis 2 astronauts at the White House this week, the visit coming nearly a month after their historic trip around the moon. I'm really pleased to say that in the studio here in New York City, the NASA Administrator, Jared Isaacman. Jared, good morning. Good to see you.
Good morning. It's great to be here.
The pictures are amazing. I understand it costs a lot of money. Can you explain to all of us what we actually achieved in the last month?
Well, I would consider that Artemis 2 is part of a much bigger plan. So President Trump, during his first term, created the Artemis program, America's commitment to return to the moon. My first day on the job, he signs a national space policy that says pick up where Apollo 17 left off, return to the moon, but go back to stay this time, build an enduring presence.
Good luck.
Build a moon base, which, I mean, it's going to be a hub for scientific discovery, economic potential. Maybe we have a lunar economy someday, but it will be the technological proving ground for where we go next, which is Mars. So all part of a bigger plan. Artemis 2 is just the opening act.
In the period of time, we have changed space exploration a lot. We've introduced commercial space exploration. What does that mean for the role of NASA as we try and achieve these things?
It's interesting. I get that question all the time because there are some new names. You have your SpaceX's and Blue Origins that get everyone's attention. It's like, where does NASA fit in? I remind folks, you go back to the 1960s. You had Boeing, you had McDonnell Douglas built the Gemini spacecraft. You had Grumman that built the lander that put the astronauts on the moon. Many of those players still exist today, but we have some new ones, SpaceX, Blue Origin. NASA's at its best when we are doing the near impossible, what no other agency, company, nation in the world is capable of accomplishing. And when we figure it out, if NASA can be one customer of many, we hand it off to industry and let competitive dynamics make it better, cost less. Launch is a great example right now. Dozens of companies brought down the cost, put mass in orbit materially. NASA recalibrates, like that picture you had on the screen, which was a nuclear-powered spaceship. That's not something industry should be playing with. They don't need to mess around with highly enriched uranium launch, reactors over Earth. That's something that NASA is capable of doing. So we recalibrate again back to the near impossible. The capabilities allow us to explore the outer solar system.
I think about the space race down back in the 50s and 60s and how much that put grants in all sorts of academic centers to try to get up new scientists, to get them into exactly that kind of thing. Is this kind of what we're replicating here?
Well, I like to think, and I just told this to Congress this past week, is every dollar you give us, inherent in it is inspiration. So, of course, the rockets, the astronauts walking on the moon, the X-planes, the images that come back from James Webb Space Telescope or our rovers on Mars. But that's not enough, right? That's enough to spark the interest, more kids dressing up as astronauts for Halloween. But we still have a huge grant portfolio that goes out to university. We have a top internship program right now. We take the top 1% of internship applications. And what I like about our moon-based program right now, we're going to have landers on the moon on a near monthly cadence starting in early 2027. We could raid the pantry at every NASA Center for Science instruments. There won't be enough. So what does that mean? There's kids in universities right now in the United States and across the world that are working on hardware that's going to be on the moon in the years ahead.
There's an argument, why focus on space when we have a lot of problems here on Earth to fix? Can you give us a sense of some of the scientific progress that's coming from some of these programs that has real-world application beyond just necessarily hyperscalers on the moon?
Sure. Well, I mean, first, we've been hearing, this since the 1960s, too. And what I would say, it's a different budgetary environment now versus then. So 1960s, NASA was about 4.5% of the discretionary budget. We're about 0.25% now. So I would argue we can do both. We can make investments into a brighter future for the world we want our children to grow up in, and try and address some of the hardships, the affordability, the challenges of the world we live in today. And does it matter? For sure. Inspiration is a price worth paying for the next generation to take us even farther. Scientific, economic potential. I mean, we go to the moon. What could a lunar economy look like someday? I mean, whether we are 3D printing satellites like you described, or maybe we're mining helium-3 that could have quantum implications, or future fusion power, a source of future fusion power. Not to mention just knowledge. I mean, what do we stand to learn and gain? We've only just begun this great adventure.
Can you achieve these goals with budget cuts? They're the questions you've faced all through the last few weeks.
Well, I guess, and I'll tell you the same thing I told Congress on that, is you can't just look at the president's FY27 budget request without taking it in combination with the historic $10 billion investment that came from the Working Family Tax Cut Act, that one big, beautiful bill, President Trump's signature legislation. You take that $10 billion plus 26 appropriations plus 27, what can we do? We can go back to the moon. We can do it with frequency. We can build a moon base. We can launch a giant nuclear-powered interplanetary spaceship and do all the other things.
You've been to space. Not once, but twice, right?
Yes, sir.
I don't have the imagination that you have about what this could be. When I hear things like data centers in space, I'm like, these guys are crazy. I just haven't flexed that muscle. I was never into sci-fi. What could this be? What do you tell people? How imaginative do you need to be?
Well, let me hit that on 2 points. One, what is my takeaway from coming back from space twice at this point? We are at, with respect to even exploring our solar system, let alone the galaxy that or the 2 trillion other galaxies out there. We are at the equivalency of hollowing out a log and using it to float across a pond. Like, that is where we are at in this great adventure. It is so early. You've no idea where this is going to take us in the years ahead. And then, how do we get there? Well, a space economy sure would be great, because I don't think we're going to have that sci-fi future we imagine with lots of space stations and orbital outposts into Mars base if it's entirely paid for by the taxpayers. So I want data centers in space to work. Why not take advantage of a giant fusion reactor that's already out there? I want, I want us 3D printing organs. I want us making cancer-curing drugs in microgravity. I want all that to come to fruition. We can't force it into existence at NASA, but we can do all we can to ignite it.
You know, when Jared walked into the studio, one of my first questions to him was, you've made lots of money, you've had this great successful life in private business, why do you want to go into government? I've never heard someone so excited in their job in government.
He feels like he can make a difference. I don't know. It's very exciting to hear. I wish I could hear you talk for the rest of the hour, frankly, because to me, this is really the exciting stuff where we can actually innovate and find new places. Do we want to find aliens, though? Do we actually want to find other life? I don't think so.
Personally, I don't.
Why would they be?
No. This is the heart of what we do at NASA, is to answer the question, are we alone?
Okay, are we?
I don't know how across 2 trillion galaxies that we are not. When I have this conversation with a lot of folks, and we have missions out there, right? We launched a probe to Europa called Europa Clipper looking for biosignatures. We're launching a nuclear-powered octocopter to Saturn's moon of Titan to look for biosignatures. And we have samples in tubes on Mars. And if we bring those back, we put it at a better 90% chance of
We're about to hit the break.
life.
And you know what the conspiracy theorists are going to say? They pulled the plug. They pulled the plug, they wouldn't let him speak.
He was about to say it.
He was about to say it. Jared, thank you, sir.
Absolutely.
Appreciate it.
Thank you very much.
Jared
Great to
Isaacman there, the NASA administrator.